Other marked moves across these sectors worth flagging for you. Industrials up 0.6, retail up 0.6, and the consumer sector also posting gains of 0.7%. But the standout is technology at this point, gaining almost a full percentage point, as is utilities, by the way, up by 1.1%. Energy, though, down 0.1% so far in the session, Anna.
OK, lots to think about this morning, then, and that Spanish CPI print, even if that was not the source of the ECB's real concern around inflation over recent months and years, certainly playing into the overall theme about a softer inflation picture in the Eurozone. Let's park that to one moment and focus in on some of the UK themes driving markets today. Sophia Horta-Acosta joins us from the Markets Today blog and can take us, at least to start with, through some of the UK stories. And one in particular stands out around house prices. Good morning again, Sophia. House prices are falling in most parts of the UK. This is according to the website Zoopla.
Exactly. So in 4 out of 5 local authorities, we're seeing house prices falling. This compares to about 1 in 20 as recently as 6 months. So house price declines are spreading across most regions in the UK. The caveat to that, though, is that it's not a steep drop in house prices. And actually, the number of places where prices are down more than 5% is very, very, very low. And what's happening is that you're not getting buyers into the market because they don't think that there's a good bargain, because we're not off the highs from last year. Properties are still very expensive relative to people's take-home pay. So actually, transactions are cratering. And the expectation is that residential transactions will fall to about 1 million this year, which is very low historically. I'm looking here at the charts, and we have the chart here on the screen. If you look there, it compares historically really, really a low number of transactions. So you're not getting those moves in house prices that are making affordability better. OK, so the transactions, as you say, are cratering. I guess the question is, to what point do lower transactions result in sellers being forced to cut prices more? But so far, as you say, we're not seeing that at a huge level. When it comes to we zoom back out and look at the equities story then, and you're flagging a piece by Mike Wilson of Morgan Stanley in terms of his view year to end of equities. And it's worth just recapping. So the S&P is up still about 6% year to date. The FTSE 100 is down about, I think 2%. And the European Stock 600 is up just 1% year to date. Talk to us about what Mike Wilson sees by year end. So famously bearish. Yeah. He's bearish right now, and actually his bearish call on the equity market has been playing out. He's saying, actually, if you look at what the market is doing, you're having falling earnings revisions. We're smack in the middle of earnings season, and actually companies that are disappointing on earnings are getting really, really punished in the equity market. Maybe there's a reality check there. Narrowing breadth, this essentially suggests that only a few stocks are holding up the equity market in the S&P 500. And also, if you look at the NASDAQ, it's probably even narrower. And business confidence and consumer confidence is falling. So that's telling a different story, he says, than actually those people, the optimistic calls on the market that are expecting a year-end rally. Is it too early to talk about a Christmas Santa rally?
It's nearly, believe it or not, it was nearly the end of October. this fact shocked me earlier, Sophia, but yes. So I think the answer is it's not too early. You have also quoted this morning some interesting piece of research from one of our colleagues, Michael Masika, talking about how this earnings season marks a reset of expectations. Tie that into what we're hearing from Wilson. Yes, exactly. Yeah. So those earnings expectations are falling. This is really good analysis from Michael. It's the sales disappointment as well, especially in Europe, where you're really seeing kind of the macro conditions here, which are softening across the region. And that's really why. I mean, if we bring in what you were saying earlier about inflation, the economy is softening. Those interest rate hikes are feeding through, and now we're seeing that feeding through to corporate earnings. So a reset of expectations on the analyst side. Revisions are coming down. Let's see. We still have quite a few weeks left of earnings season here in Europe. So a lot of data still to digest, but at the moment it's not looking pretty. OK, I think you marked this in the diary. This is the first time that we talked about the Santa rally, and that's down to Sophia on October the 30th. For me, it is too soon. Sophia, thank you very much indeed. Sophia Horta-Acosta from our Markets Today blog. Thank you. You can get more, of course, from Sophia and the rest of the fantastic team on the front page of the Bloomberg UK website, or by typing TLIV GO on the terminal. Let's get to what is on our agenda for this week. Today, we're watching out for German GDP and inflation data, including the Germany-wide CPI reading at 1 p.m. UK time. We've certainly had dovish building blocks up to this point from the various states in Germany. Tomorrow, the Bank of Japan delivers its latest rate decision. There will also be Euro area CPI and GDP, so the whole Eurozone picture there. On Wednesday, that's Fed Day. Markets are expecting the FOMC to hold at 5.5%. We'll also get the Treasury's quarterly refunding statements. So how much long-term debt does the Treasury need to issue? That's going to be crucial, given the focus on just how high 30-year yields have been of late. On Thursday, it's the Bank of England's turn, with the central bank also expected on hold at 5.25%, so a bit of a placeholder expectation for those two central banks this week. The BOE is also publishing its monetary policy report, with Governor Andrew Bailey holding a news conference. Apple also reports earnings after the bell in the United States on that day, so that'll be a focus for us into Friday's session. And rounding out the week on Friday, we'll watch out for the US jobs report.
OK, coming up, economists say a big government debt sales by China will spur a cut in the bank reserve ratio. We bring you the details next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Your grandfather was a famous basketball player. In fact, he's in the Basketball Hall of Fame. Did you have any of his basketball genes?
You know, in my family, David, you didn't do very well at the family barbecues if you couldn't play hoops.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Markets Today, 10 minutes into the European trading session, and we have European equity markets moving a little higher, a slightly more benign picture for European inflation coming through, and some of the regional prints in Germany, the national print in Spain. We'll look for those building blocks as we go through today and tomorrow, but that seems to be one of the influential stories this morning. Let's get a check on some of the individual stocks on the move, though. Joe Easton from our equities team has a briefing for us. Joe, good morning again.
So HSBC ticking higher now. It did open lower, actually, but they have done a $3 billion buyback. Seems to be outweighing some of those added costs and also some slightly weaker numbers, some of their headline profits as well. Stanchart is ticking lower. Morgan Stanley cutting their price target. And it's been an awful banking reporting season here in the UK. I don't remember one as bad as this for a while. And we've also got Jefferies double downgrading NatWest to underperform. The first time they've had a sell on that stock for over a decade, so you can see how negative analysts are at the moment. Siemens Energy fell off a cliff on Friday on funding worries, coming back up today, one of the biggest gainers. An executive was keen to emphasise they don't need money from the German government in an interview at the weekend, so that's getting a boost this morning. Then on the next screen, we've got Pearson. Now, Pearson, they're doing a buyback as well, also beating forecasts in terms of their analyst numbers out today in a statement. That one doing well. Wow, that's a big one, though. 33% for Essential. This is a data and analytics company selling a unit to Omnicom. Could be worth around £1.2 billion, according to them. That's the biggest gainer we've got in London today. Vodafone ticking higher, also M&A related, selling part of their Spanish business, according to press reports, 50% of that. It's a big business for them, worth around $5 billion, so they could be getting half of that money. And ASOS is in talks to sell their Topshop business that they bought only a year ago, so kind of questions why they did that deal. I've had a couple of questionable blazers from Topshop over the years as well, of course. Just quickly, on this final board here, we're going to flip over once more and see what else we got. ArcelorMittal, tragic news of a coal mine incident over the weekend in Kazakhstan. They've issued a statement on that one. That one's the worst performer on the Stock 600 today. Very serious news for them. Frasers Group, M&A as well. They are potentially doing a deal with their Misguided business, selling that to Shein in China. This is breaking news for them. Mike Ashley's company offloading Misguided. So a couple of fashion news today. Rightmove gets a broker upgrade this morning. Now, that one was hit hard due to worries about on the market potentially encroaching, in Swedish orphan biopharma company up 5% after earnings.
Joe Easton from our equities team, thank you very much indeed on some of the stocks on the move this Monday morning. Let's get back to what's happening in China now. The world's second largest economy, and the central bank there may cut the amount lenders must hold in cash for the third time this year. Economists at CITIC, Natixis and Jones Lang LaSalle see the PBOC slashing the reserve requirement ratio for banks by 25 basis points in the next 2 weeks. That is to ease liquidity pressure amid a bonanza bond sale. Joining us now is Polina Kurdyukov, who's the head of emerging markets debt at RBC, Blue Bay Asset Management. Polina, thanks for joining us in the studio. Let's start on China then. How much exposure does Blue Bay want to be having? How much exposure do you have to China credit at this point?
Thank you for having me here. At this point, we're underweight China credit, and we feel that the valuations are just not attractive in the context of the fundamental outlook in China.
So that, and give us a bit more detail on that. What is it about the fundamentals, Polina, that are not attractive?
When we think about the Chinese growth outlook, we are quite cautious on growth, and that's one of the reasons why we continue to see China implementing stimulus measures to support the growth going forward. Historically, their preferred measure has always been to control the volume of money rather than the price of money. Hence, the RRR cut is one of the most one of the most traditional ways to inject liquidity in the market. At the same time, we feel that when we look at the valuations in credit, the spreads on credit are relatively tight in China, and we feel that the combination of relatively weak growth outlook with tight valuations doesn't make China an attractive destination from an EM fixed income investor perspective.
Within EM commodity countries, what is the biggest catalyst right now? What is the biggest focus? Is it China or is it the Fed? What is more important for EM commodity at this moment?
In our view, the Fed ultimately is the key risk for emerging markets as well as broader risk assets, because at the end of the day, when the cost of liquidity is going high at a very rapid pace, the capital flows away from risk assets in favor of risk-free assets. At the same time, what is interesting is that in emerging markets, we've seen a big reset on the monetary policy over the last 2 to 4 years, with most of the central banks becoming a lot more orthodox and taking rates to a much higher level, which is why today in most of emerging economies we're actually seeing decline in inflation, and at the same time we're still seeing very tight fiscal backdrop. What that means is that once we see the rates starting to lower, this would be a very positive environment for risk assets, and I think emerging markets will be one of the key beneficiaries.
Okay, so if the short term, if the volatility in the rates market means negative things for EM at the moment, you still see this all laying a sort of more solid backdrop from which EM will bounce. Is that the view?
Absolutely. And in fact, you're already seeing that coming through. If you look at the year-to-date performance of emerging market fixed income, the best return has been in the local currency fixed income. This has also been the case last year. In fact, that's the asset class that has underperformed for over a decade. But now we're seeing a positive absolute return in the asset class, supported by high rates, orthodox monetary policy, and attractive valuations on the facts.
Paulina, you played a role in at least discussions around the restructuring of Zambia's debt, which came to fore recently. To what extent does the Zambia story provide a template for other distressed economies within EM?
Well, we think Zambia has been a very interesting story and an interesting template for emerging markets going forward. We have been one of the members on the Bondholders Steering Committee and have been working with the Zambian government over 2 years now to come to an agreement on restructuring the sovereign debt. And I'm pleased to say that last week there's been an announcement where the members of the steering committee has reached an agreement with Zambian government on the principle of a sovereign debt restructuring, which to us provides a very positive example and the first example of the common framework. It gives a substantial relief for the Zambian government, but it also gives bondholders a recovery well above the historical average. And to me, the key takeaway from this experience has been direct engagement between creditors and the government.
And why, Paulina, why does that make such a difference? Because there have been plenty of negotiations between bondholders and emerging market governments in the past that have taken a long time or maybe not produced strong results. So why does it make such a difference that the two talk directly?
Well, in my view, what is important is to understand what are the red lines for the government, for the official sector, for the IMF, and for the creditors, and find a template which meets those red lines but yet provides an acceptable outcome from both parties involved. And common framework is a good example where you have a lot of parties around the table, but unlike the common belief, we as creditors, as Zambia government, are sitting on the same side of the table because we as private sector who will provide lending for the country going forward are as interested in creating a sustainable path for the government as official lenders and the government itself.
Paulina, thank you very much. Thanks for joining us. Paulina Kurdiavko, Head of Emerging Markets at RBC Blue Bay Asset Management. More on the markets next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Welcome back. HSBC shares in Hong Kong are trading slightly lower today. Here in London, they're up around 0.6%. The bank has announced a new $3 billion share buyback program as it reported a third quarter profit miss on rising costs. Earlier, I spoke exclusively to the HSBC CEO, Noel Quinn.
I'm very pleased in that we've reported $29.4 billion profit for the first 9 months of this year. As you say, 7.7 for Q3. That puts us on a return on tangible equity of around 17% for the 9 months. Very pleased with the $3 billion buyback that we've announced today, up to $3 billion. That takes it to $7 billion for the full year. And I'm also pleased that we've announced another 10 cents dividend. In terms of the slight miss that people have talked about, I do want to draw attention to the fact we booked some treasury losses on some treasury instruments because we were seeking longer duration, higher yielding treasury instruments. And that loss of $600 million that we booked in Q3 will be fully recovered over subsequent quarters. So that's all about our hedging strategy rather than an economic loss. It's a timing difference between a loss today and future profits over subsequent quarters. I think we're well positioned. We have a good momentum in the business. And I think that's evident in our wealth performance. Our revenue was up 6% in the quarter. Our trading assets or our wealth balances were up 12%, I think. And we took in around about $34 billion of net new invested assets in the quarter, bringing our total growth in on net new invested assets to around about $77 billion for the past 12 months. So that's good momentum in diversifying our revenue stream.
No, on the buyback, it does come in higher than the estimates, $3 billion US dollars. You know this better than most. Investors always want more. Is there scope for more, Noel?
Well, listen, we've got very strong capital generation at the moment, as you can see in today's results. We've also announced when we sell our Canadian business in Q1, it's our intention to do a further special dividend in Q1 of 21 cents. And then we'll consider what we do with the remaining proceeds of that disposal. So I think we got good capital generation this year and good capital generation prospects for the next 12, 24 months as well. I think we're in a good position to reward our shareholders for their patience and loyalty over the past few years.
I want to talk a little bit about the China part of the story as well, Noel. You did book some charges there of around, what, $500 million US in terms of provision charges on some of the losses there. And you've talked about, in the statement, the uncertainty in the commercial real estate market of China. How do you see that story evolving? Is it fair to assume that further charges of about that size and that scope are going to be coming through in the quarters ahead?
Well, I think we signaled at the end of last year that we had a plausible downside scenario of a potential for an extra $1 billion of ECLs on our China real estate exposure. If you look at what we've done in Q3, $500 million, plus what we took in the first half, we've booked around about $800 million of that $1 billion plausible downside. There is the potential for a top up to that and book the remaining of the billion in Q4. But I think we're relatively comfortable with where we sit at the moment on our provisions. And by the end of this year, we'll have been well provided on our exposures in China. Clearly, it's an evolving situation. We'll keep it under review. But we think we're going to be in a good position by the end of this year on our provisioning.
Okay, that, of course, was the HSBC CEO, Noel Quinn, speaking to me in an exclusive interview earlier on the back of those third quarter earnings. The top line was that across those earnings, it was a bit of a miss, $7.7 billion for the third quarter. The estimates had been for $8.1 billion, but the headline grabber really came through, Anna, from that bare buyback increase, $3 billion. The estimates had been that maybe they come through with $2 billion. They came through with $3 billion, and he seemed to be suggesting there in that interview with me that they were well positioned maybe to add to that in the quarters ahead.
Yeah, that would certainly be the a carrot being dangled in front of investors, it seemed today. So scope for more returns, talking about how they are strong on capital generation, talking about some of the M&A or some of the asset sales they're doing, rather, and the way that might create funds for further return of cash to shareholders. Interesting always his comments on China, talking there about what's going on with provisioning there, around their expected credit losses, the ECL in China, but saying that the Chinese property market may be at the bottom, which is interesting.
Yeah, it's an interesting call, so we may have to come back to Noel to stress test that call, but they booked, as you say, about $500 million US dollars. But you're not seeing them punished the same way that Standard Chartered were. They also had Standard Chartered exposure to one of the Chinese banks. It looks like the comments from Noel seem to be that they can manage this situation, that there's going to be further volatility within the real estate market of China, but again, saying that he thinks that possibly the real estate market there has bottomed.
We will watch that one. Coming up on the programme, how companies in the materials sector have a pivotal role to play in decarbonisation. We'll discuss the energy landscape and the brown to green energy transition. That's with BlackRock's Evie Hambro, who joins us shortly. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that a small nation is forced to suicide.
Bloomberg. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Markets Today, 30 minutes into your European trading day this Monday. Let's get to your top stories. Israel announces the second stage of its war against Hamas, widening its ground offensive in Gaza. Prime Minister Netanyahu says the invasion will be, quote, long and difficult. In an interview with Bloomberg TV, Iran's foreign minister warns of new fronts against the US if it continues its support for Israel. Plus, in markets, HSBC announces a $3 billion share buyback program. After quarterly profit misses estimates, shares head slightly higher at the start of trade here in London. Tom, so half an hour into the trading day in London, and there are earnings stories, of course, to talk about. There is, of course, the focus on the geopolitics, the humanitarian costs very real, the risks around geopolitical escalation still on investor investors' minds. But given the scale of what we've seen so far over the weekend, room for risk assets to rally, and that's what we're seeing this morning.
We are seeing a bit more convincing optimism now across the European equity space. Of course, after a challenging week for European and US stocks last week, you're currently seeing the European benchmark up 0.8%, the strongest upside coming through across these major indexes from the FTSE 100 here in the UK, adding 68 points, 0.9%, still below that 7,400 level for the FTSE 100. The DAX also performing relatively well, adding 83 points so far in the session, up 0.6%. Let's get a bit of colour on the sectors then. Flip the board. The last time I checked, it was media that was at the top of the list. WPP putting in a very strong performance in terms of course, the advertising heft that comes through with that business. Technology also up as a sector, around 1%. We're getting a slightly more benign inflationary picture filtering through from Europe. We've got the German data that came through earlier this morning in terms of the regional print, and then, of course, Spanish CPI as well coming in slightly softer. And you're seeing yields coming in. Of course, that is good news for the tech space. On the tech story, we looked at earnings out of Apple later this week. Travel and leisure getting 0.8%, food up 0.8 as well. Energy has actually turned positive despite the softness that's come through on oil prices over the weekend, just gaining 0.4%. And there's the picture on retail, gaining 0.9. Across your sectors then, it's green on the screen, a little bit more optimism to kick off the week, at least so far. Anna.
OK, let's get an update on what's been happening in the Middle East then, Tom. Israel has widened its ground offensive in Gaza, raiding a West Bank city and conducting an airstrike in Syria in what it is calling the second phase of its war against Hamas.
The war inside the Gaza Strip will be long and difficult, and we are ready for it. This is our second war for independence. We will fight for our native land. We will fight and won't back down. We will fight on the ground, in the sea and air. We will eliminate the enemy on the ground and under the ground. We will fight and we will win. It will be the victory of good over bad, of light over darkness, of life over death.
Let's get more with Oliver Crook in Tel Aviv for us. Ollie, bring us up to date with the latest this morning.
That's right, Anna. We're now entering the fourth week of this conflict and the new chapter from the Israeli perspective in this war. The new stage, as Benjamin Netanyahu put it. And what is this new stage defined by? How is it marked? It is a greater ground presence within Gaza from the Israeli military. We saw the greatest sort of action on that front happen over the weekend. There had been previously sort of very targeted and limited entries into Gaza, but you saw the most significant version of that. However, this being said, this is not the full ground invasion that many people had anticipated in the lead up. We had heard from Israeli officials who are really tamping down expectations for that sort of thing to happen, and that it might be a lot more prolonged and a lot more tactical. Now the question is how long? And so we heard from Netanyahu saying a long and hard battle. That could be 6 weeks. It could be 6 months. That is from officials that we have spoken to. It is not clear why are they going about it this way. There are still a great many hostages held by Hamas. There is a lot of international pressure from the humanitarian front, but also the real risk of escalation, which is, of course, what everyone is watching. We heard from the Saudis, from the Emiratis over the weekend, who are condemning this new stage of the war. The Iranians made some of the same comments we've heard throughout, which is saying that this could open a new front. However, there's nothing very new there. So where do we look in terms of those indications of escalation? We look to the border with Lebanon, where there has been continued tit-for-tat firing from the two sides. Nothing, again, is a major step up. Some strikes in Syria from the Israelis. And we watch also within the West Bank, where we understand there have been some clashes. And also something that we're hearing from Lebanese television is we may hear the first public statement from the Secretary General of Hezbollah this Friday. So these are all the flashpoints that we watch for when we consider the escalation risk.
OK, Oliver Crook on the ground for us in Tel Aviv. Thank you, Ollie, for the latest. Let's zoom the lens out, or at least widen the lens in terms of the broader geopolitical reaction to the action on the ground in Gaza. Let's bring in Daybreak's Middle East and Africa anchor, Yusuf Gamal-Eddin. Yusuf, what does this mean then for the broader region?
Well, there's a lot of anxiety and nervousness around the stakes and the possibility of this spinning completely out of control into a regional war. That kind of urgency really comes to light with the visit of the Saudi defense minister. He is en route to the United States. He's expected to arrive in Washington, D.C. in the coming hours. He's going to sit down with the U.S. Defense Secretary Lloyd Austin. He's going to sit down as well with the Secretary of State Antony Blinken. The Saudis making it very clear that the global international community needs to move meaningfully towards a sustainable and lasting solution and a way to end the violence. The Qataris are also playing a very important role, and they have from the get-go. They host the Hamas leadership, and a big take from Bloomberg looks at the finer points around the Qatari effort. But they've been hitting the phones from the get-go with both sides, the Israelis and Hamas, trying to broker a deal that would see a release of Israeli hostages in exchange for some Hamas individuals and Palestinians being held in Israeli jail. There's not been a breakthrough. But the stakes are high for Qatar. There's a lot of pressure for them to deliver, especially given the expectations that they've set around their ability to influence some of the Hamas policy decisions and some of the thinking within that group. So we're going to continue to monitor that front. Guys?
Yusuf, thank you. Bloomberg Daybreak Middle East and Africa anchor Yusuf Gamil Eldin with the latest on the broader geopolitics around the current conflict. Let's switch our focus now and turn to the energy transition conversation. The global shift to low-emission energy is an opportunity that spans many asset classes and regions. BlackRock sees one of the most important elements being the shift from a brown economy based on fossil fuels to a green system reliant on metals and materials. Joining us now is Evie Hambro, Global Head of Thematic and Sector-Based Investing at BlackRock, with a deep dive into the mining landscape. Evie, very nice to have you with us, as always. And we've talked a lot about the role that metals play in a move towards an electrified economy rather than a fossil fuels economy. But you shine a light in your research on the companies that do this mining and the extent to which they can turn themselves green. What are we learning on that front?
Yeah, well, thank you very much for having me on. It's great to be back. I think that the first thing to say is that, the direction of travel is incredibly clear. It's wonderful that we're going towards this future that's going to be moving towards more of a kind of mechanically captured energy environment rather than the kind of hundreds of years we've been addicted to fossil fuels and everything attached to that. So we're very excited about that as an organization. But I think one of the things that we've noticed is that there's this kind of broad complacency amongst investors, amongst the world at large, I suppose, in terms of taking material supply for granted. And in the way that we're thinking about this, we see lots of things we've spoken about before when coming on to show the differences between demand and supply, and if there's not enough investment into supply, then there are going to be shortfalls with regards to what's needed for the transition. But I think the thing that's gone most overlooked is the fact that not only are these companies going to be producing the things that are needed or essential for the transition, but they themselves are changing. I think it's very easy to have a kind of muscle memory or a bias towards this sector, which is one of a negative view, kind of the backward-looking approach to sustainability, on scoring companies on how they've done in the past, rather than thinking about how they're going to do in the future, or actually what they're doing to become better in the future is very much overlooked by most people. So the actual transition at large for the global economy is actually happening at the companies themselves as well. So when we think about it, we're looking not just at the kind of obvious things, the renewable technologies, the electric vehicles and so on. We're actually looking at the entire supply chain and seeing how that supply chain is changing. And when we look at areas that most people either don't want to look or are not allowed to look or have overlooked, then we see a lot of opportunity in that.
So if this is being overlooked, then there clearly is an opportunity, and there's a valuation proposition as well. Just give us a bit more detail on where that valuation, or at least where that investment opportunity is. Do you want is it better to get direct exposure to, for example, the copper producers, or do you want to be further up the kind of value add stream in terms of how you position around this proposition? Where are you finding the most value?
Yeah, I think there are going to be, there's lots of sources of value here. I mean, you can do the obvious stuff. You guys have got fabulous charts. You can go and look at where the companies are trading today relative to where they've traded themselves in the past, or where they're trading relative to broader markets. And on pretty much every single metric, you'll see that they're trading at the lowest levels they've been for many, many years, if not decades. So that's the obvious valuation stuff. I think the other things that we're starting to see is things that I guess less obvious. So these companies now getting access to capital at a cost that's dramatically lower than they've been able to get access to money before. That money is coming from governments. We're seeing the US IRA, European Green Deal. This is all designed to incentivize the transition of materials production to grow it firstly, but also to transition it away from the kind of ways that it has been produced in the past, so becoming greener. We're also seeing customers looking to provide capital to these companies as well. So you're seeing the big automotive OEMs going out and realizing they've got supply challenges building relative to what they need. So they're going upstream. They're going to their customers and their suppliers, and they're saying, what can we do to help you grow production? How can you transition your own production so that we can say to our customers that we've decarbonized the last unit? You've got fabulous data on the New Energy Forum that you have. You think about an automotive vehicle, 60% of its emissions over its life come from the fuel that it burns. If you switch away from that and go to renewables, you eliminate the 60%. But what about the 40%? The 40% comes from the manufacturing. And if we really want to decarbonize the world, we've actually got to lean into that and think about where is the stuff that we need coming from, how it is being produced, and is that production process changing?
Okay, and how does this fit into the sort of broader ESG conversation then, Evie? Because it's interesting to watch how this has evolved. If you look back to the sort of pre-war in Ukraine era and the very low interest rates environment, there seemed to be perhaps a more purist view of what ESG was all about and very strict definitions about types of companies that simply wouldn't qualify. And now maybe we're in an area where views are more pragmatic. I mean, it depends which products you're looking at, of course, and depends on the mandate that each investor has. Exactly. But do you see this sort of thinking evolving and more investors looking in the direction that you're pointing at?
Yeah, I think that's a really great point, Anna. And so when we've been out speaking to customers and to clients about this now for a few weeks, and I think that one of the things that's resonated the most with those clients is that we're actually doing ESG slightly differently in this fund. We're not beholding ourselves to the kind of backward-looking, data-driven ESG frameworks that many of the regulations are kind of implying that you must follow. We're actually taking a bit of a risk, and we're going into deep dived work with the companies, working out whether they're going to change, whether their plans are realistic, whether they're robust, financeable, whether they're technically possible, whether the time frames are going to be achieved. And if we believe those companies can get better, there's a chance that their valuation is going to change. And we've seen that in other industries. If you look at the utilities space, as utilities have moved away from fossil fuels, their multiples have expanded as they've gone towards renewables. They've got access to lower cost capital. We see a very, very similar pattern happening in the materials space. When they start to go through this green transition themselves, then the opportunities are going to open up. And not only that, we're also seeing differential pricing models coming through. So I'm sure you guys have explored this before, but when a customer wants to get access to something that's got zero emissions attached to it, they're going to pay a different price than the market price because it's a value in use to them in how they communicate with their end customer. Supplies are very small right now. We're in an early stage, a kind of nascent phase of price discovery. As those volumes grow, I think this is going to become much more obvious. So the business models are evolving, the cost of capital's decline, the companies themselves are getting better and getting greener. There's a really great chance there's a lot of value there that's been missed by most people.
Okay, Evie Hambro, thank you very much indeed on the missed value around materials and metals, and of course that brown to green materials fund at BlackRock. Evie Hambro, Global Head of Thematic and Sector-Based Investment at BlackRock. Thank you for the context and the analysis. Coming up, the City of London has fewer finance jobs to offer after a post-pandemic hiring boom left companies overstaffed. We discuss that story next. This is Bloomberg.
When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which are have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The UK wants to be a world leader in AI, but does it have the jobs to match? Bletchley Park, where Alan Turing spearheaded Britain's code-breaking efforts in the Second World War, will play host to a global summit to discuss the future of the technology. But while Rishi Sunak tries to push ahead with AI, data suggests that jobs in the field are drying up in the UK. AI roles posted on Reed Recruitment in the 3 months to September were down almost 40% on the same period last year, and down 61% from the peak in 2019. But while openings have declined, interest has shot up. The number of applicants in June and July was almost double that in 2022. So it appears that employers are taking a cautious approach to the new technology. But James Reed, the chairman of Reed Recruitment, says it's more likely that AI skills will become embedded in existing roles rather than spun off as specific AI jobs. When it comes to AI job hotspots, per capita, London is trailing far behind university towns like Oxford and Cambridge, despite the capital's larger tech sector. That suggests that AI is still an exploratory field, tied to centres of innovation and technology before expanding its influence across the broader economy. Given the pace of change, many experts agree that whether specifically in the field of AI or not, most of us are going to have to learn AI skills for future jobs.
That was Bloomberg's Alex Morgan breaking down the latest data from Reed Recruitment with a focus on AI. Sticking with the jobs market, the City of London has fewer finance roles to offer after a post-pandemic hiring boom left companies overstaffed. A report by Morgan McKinley says that finance jobs postings in the square mile have dropped almost a third in the quarter to September from a year earlier. Let's bring in real life, nothing artificial here, Tom Metcalf from the Bloomberg finance team. He could talk us through the story here. So we were hearing there about how AI jobs, not so many of those seem to be drying up, but also jobs in the finance sector, there are not as many of those available as there were.
Yeah, exactly, and that sort of decline of about a third you mentioned there. What's interesting is in contrast to that AI report, there's also far fewer sort of applicants for those jobs, and that's because, you know, if you're in the finance space, you're seeing the markets getting tougher, so you're much less inclined to go out there and sort of apply for jobs just because you realise there's not that many opportunities out there, and if you are going to be in that process, it's going to take months and months.
In the banking sector, how much of this is about just adding too much headcount during the pandemic to make up for all the activity that was going on then versus broader pressures across that sector? What are we seeing in terms of the banking space when it comes to jobs?
Yeah, I think that's really important context. If you look back, there's huge hiring in the pandemic, so this is all against that as a backdrop. And, you know, yes, certainly I think almost every bank we talk with, point that out. It's like, look, we hired very heavily, so inevitably, especially as times get a bit tougher, we're going to hire less and indeed get rid of people.
And sticking with the banking sector, we've got HSBC numbers out this morning. The share price was responding tentatively, but boosted by the buyback, no doubt, over at HSBC. And perhaps more to come, sensing that?
Yeah, the CEO earlier on Bloomberg Television, certainly you could read between the lines and suggest there's going to be more buybacks or more sort of shareholder capital returns. And, you know, it's a refreshing change for me. Last week, pretty much every bank that came out, the stock got absolutely hammered. So today, at least, HSBC saying, hey, we're expecting buybacks. They were describing it as a very strong quarter. It actually seems to be relatively positive news for them.
Yeah, the share price action here in London up 0.6% on HSBC. Tom Metcalf, thank you very much indeed, of course, from our finance team, leading the finance team here in London. Coming up, a potential soaring neutral rate and influx of treasuries leaves rates traders on edge. We discuss that with Bloomberg's MLive's Sven Ram next. He's going to give us the context and the analysis. Stay with us. This is Bloomberg.
looked, I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
This is Bloomberg. This is Markets Today, 53 minutes into a European trading session that actually sees risk assets going higher. Oil prices down quite substantially, down 1.5% on Brent at $89. We see stocks on the rise this morning. Let us talk about what's happening in these markets. Ven Ram joins us from our Markets Live team. Ven, very good to have you with us. A lot of focus on fixed income, a lot of focus on European fixed income with the inflation data coming in quite benign today, a focus on the long-end issuance story in Treasury markets over in the United States. Your focus on the neutral rate. Now, I wonder where our thinking has got to on that point. A lot of discussion about whether the neutral rate is higher now than it was pre-pandemic. What's the influence that this is having?
Well, I mean, we ran an MLive pulse survey, and that shows that majority of the readers think that the real neutral rate is somewhere above 100 basis points. If those estimates are right, that means that nominal rates will be underpinned, and we could see with this Treasury refunding announcement, we could see a further impetus in nominal yields that could take the 10-year Treasury yield beyond 10%, beyond 5%, I'm sorry, and also the 30-year yield, nominal yield will rise in tow as well. Now, I mean, we got the deficit numbers from the US last week, and those were like double what they were previously. And that combined with an economy that's doing pretty well. We got the third quarter numbers last week as well. Those were pretty stellar as well. So all these point in the direction of higher nominal yields, Anna.
Yeah, so the higher nominal yield story, with all of those factors weighing, of course, the Treasury Secretary says it's got nothing to do with the deficit. It's all about growth. What does that mean across the equity space then, Ven? How vulnerable is the Nasdaq? How vulnerable is tech if that comes to be the reality then in terms of the nominal rate, in terms of the neutral rate?
On the, you know, if nominal rates keep surging higher from current levels, we're already around 5%, of course. So, you know, most investor groups use 5% as their discount rate to value stocks, to bring the future value of stocks to the present value, use the 5% discount rate. So if that 5% discount rate is going to go to 5.5% because Treasury rates keep surging higher, then that has a whole lot of implications for stocks. Stocks have, of course, withstood the onslaught of higher rates so far. But if it goes to 550, then the discount rate calculations kind of need to be reworked, and that means that stocks will feel the pinch at some point.
And which stocks then, Ven? Is it going to be, we were having a conversation with a guest in the first part of the programme. He was saying it's actually changed from when the high growth stocks were being hit in 2022, saying now it's more the bond proxies. Where do you see the pain falling?
I think the long duration stocks, i.e. the technology stocks, will bear the brunt, simply because, you know, in terms of AI fraud, there's a lot of AI fraud. If you look at the Nasdaq 100 composite, Nasdaq 100 index, the fair value is around 12,800. We are now, of course, at 14,000. So there's a lot of frauds to be unwound there. And there's also a lot of fraud in terms of the PE valuations alone. I mean, we are at 28 PE. That's unsustainable over the long term.
Okay, on the froth unwind is Ven Ram, of course, from our Markets Live team. Thank you, Ven. Remember, you can get up-to-date analysis and insight from Ven and the rest of the team. Just go to MLIV. Go on the terminal. That is it for markets today. European stocks are currently up 0.6%. US futures are in positive territory between 0.5 and 0.7%. You can get insights from the rest of the team, of course, on the front page of the Bloomberg UK website. Stay with us. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
A very good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Israel widens its ground offensive in Gaza as Prime Minister Netanyahu faces criticism for his unwillingness to accept responsibility for the Hamas attack. Meanwhile, Iran's foreign minister warns of new fronts against the U.S. if it continues to support Israel. HSBC announces a fresh buyback program despite announcing profits that missed estimates. CEO Noel Quinn touts capital strength in an exclusive interview with Bloomberg. An appetite for riskier assets recovers ahead of a long list of corporate earnings reports and a slew of central bank decisions from the Fed, the BOJ, and the BOE. A very good morning. Welcome to Bloomberg Brief. We're just getting the German preliminary GDP data coming in across the terminal. It falls by 0.1% on the quarter. The estimate was for a drop of 0.2%. Of course, we've already had North Rhine-Westphalia inflation data coming in a little bit better than expected. But you've got the DAX following the rest of the equity markets a little bit higher. 10-year yields flat at the moment, down ever so slightly on that better than expected North Rhine-Westphalia numbers, but no real reaction to the GDP, and the euro-dollar remaining unchanged. Let me take you through the rest of the market. So you have that narrative in Europe, which is about inflation, but to the bond market, it is going to be about the size and the scale of refunding. Today, we're going to get the quarterly borrowing estimates. But the bond market's day of reckoning will come on Wednesday, according to Ayn Lingen and a number of other market protagonists that say it is going to be about the Treasury and not the FOMC. In other words, the size of 10s, the size of 30s that you're going to get in terms of supply coming in across this market will define the next move. Crude oil drops by 1.85%. Do you believe that there is containment? That is the question. That is the fundamental question you must ask yourself when you look at the oil market. Do you believe that the Hamas-Israel war is contained, or is there a risk of it really, really expanding? And that is the assessment this morning, is that escalation fears drop. But is that enough in itself? Oil is down. The Iranian foreign minister, we'll hear from him later on, warning, very clearly warning, any continued support by America to Israel will simply involve an opening on major fronts. Hedge funds have slashed their positions to the lowest in 2 months. And gold is down. The reason why I bring you gold is because gold has been this I suppose, really phenomenal hedge. It has gone up by 9% since the Israel-Hamas attacks. And that is really the defense of all defenses as a hedge in this wartime. Danny, good morning.
Good morning, Manus. And maybe as we flee gold, we go into risk. Let me quickly walk you through your equity market check. We are higher across the board this morning. Futures starting on the front foot, up by more than 0.5%. Perhaps not surprising considering we entered a correction at the end of last week, and we are on track for our worst October in 5 years. Lori Calvasina says the narrative from the earnings, it is bending, not breaking, but she calls the pessimism striking. That pessimism reflected in your VIX, it's just below 21%. Entering a second week above 20, though we are coming down ever so slightly. European stocks also doing better this morning, Manus, up 0.6%. HSBC, the earnings we're going to walk through with Tom Metcalf in just a few moments, but you can see that at the bottom of your screen shortly. HSBC shares fighting the propensity to move down on weaker earnings because they did issue a $3 billion buyback. But Manus, as the kids get ready to don their Halloween costumes for trick-or-treating tomorrow, for this bond market, it is spooky season, and you can groan at that all you want, but it is true. We've got what? A Fed decision, BOJ, and a BOE decision, and the quarterly announcement that you mentioned, as well as payroll numbers. That is a lot to digest. I hope you've gotten your sleep, because that is a wall of worry, or as Doug Ramsey at Luffield Group calls it, the wall of worry has morphed into what? A slope of hope.
Well, that slope of hope. Don't worry, I'll be down in Greenwich Village tomorrow night for the Halloween parade, fully decked out. I can't top Anne-Marie Horden with her Halloween costume. No, I'll be wrapped up in bed at 6 p.m. tomorrow night. But on a slightly more serious note, what is the bid? What is the bid? Seriousness at 5 a.m. What is the bid to the bond market? The bid to the bond market is what the Bank of Japan might do. They could be that vortex, that vacuum that sucks some liquidity out. The offer on the other side, what you're looking at is that quarterly refunding. So I think it is a very, very delicate moment in the bond market. Ian Lingham was with us last week, and he said this is a pivotal week and will define the top of the bond market. Where have we heard that before? But let's return to our top headline, Danny. Israel has ramped up its ground offensive in Gaza. This is President Biden holds a call with Prime Minister Netanyahu to underscore the need to protect civilians. This is as Iran warns of new fronts against the US if the war drags on. I spoke to the Iranian foreign minister on Friday. Let's take a listen.
If the United States continues what it has been doing so far, then new fronts will be opened up against the United States.
We'll hear more from the Iranian foreign minister later in this show, but some serious threats being raised if the ground offensive was of a significant size. Let's bring in Oliver Crook. He's back in Tel Aviv. Oliver, what is the latest over the weekend on the conflict?
That's right, Manus. We enter now the 4th week of this war, of this conflict, and with it, a new chapter or a new stage, as Benjamin Netanyahu says. How do we define this new stage? It is marked by a greater ground incursion by the Israelis into Gaza, the most significant we've seen since the beginning of the war, with tanks and soldiers. However, it still falls short of the full-scale invasion many had anticipated in the lead up to this. So really the question is, what does this look like going forward? There is some ambiguity here, some of that by design, and we speak to officials. They say it could be 6 weeks weeks, it could be 6 months. Again, this is still developing. And why are they going about it this way? For one thing, there are still more than 200 hostages being held by Hamas. There's international pressure on the humanitarian front, but then there's also, as you've highlighted, that escalation risk. So we heard from the Saudis, the Emiratis over the weekend, who are condemning this new stage in the war. We've heard from the Iranians, who are speaking in many of the same terms we've heard throughout this crisis. But the question is really going to be, what is next? The U.S. sees still a very elevated risk of escalation. And so where do we look at? We look at the northern border with Lebanon, still exchanges of fire there, not a huge step up, some strikes within Syria, but we also keep our attention, Manis and Danny, on the West Bank, where we understand there are some clashes there. And we also understand from Lebanese news agencies that we will hear from the leader of Hezbollah for the first time at the end of this week on Friday in a televised address.
Oliver, following the October 7th attacks, there was a unity government formed in Israel, but now we understand that Netanyahu is under pressure for his unwillingness to accept responsibility for the attack. There was a deleted tweet over the weekend. Is there a sense that some of that unity has broken down?
There's certainly rising pressure, and what's interesting is that it sort of came from Benjamin Netanyahu. So right after a press conference that was given by the 3 members of the war cabinet, one of whom is in opposition, right? So this was sort of a symbol of unity, this government coming together to wage this war. Netanyahu put out a tweet or an X saying basically that he had not been alerted to anything, that Hamas had been sort of deterred, according to all of the intelligence agency, really shifting the blame onto the military and the intelligence agencies. This was taken extremely poorly, including from within the war cabinet. He deleted the tweet. He apologized. But again, the broader context, Benjamin Netanyahu is a very polarized figure within Israel. There are hundreds of thousands of people taking to the street every single week before this happened, and they really rallied behind the war effort. And now for him to do this was seen as a real sort of breach. And again, it adds to sort of mounting pressure for the prime minister.
Oliver, thank you very much. That is Bloomberg's Oliver Crook in Tel Aviv. All right, let's get you some of the other top stories this morning that are trending on the terminal. And Manis, the UAW has expanded its strike against GM, now the only Detroit automaker without a deal with the union. Workers walked out of the plants in Tennessee on Saturday. Ford and Stellantis have both reached tentative deals, but now Stellantis is facing a strike in Canada after talks there failed with more than 8,000 workers.
The former U.S. President Mike Pence has ended his presidential campaign, ending his quest to unseat the former running mate Donald Trump. Pence's campaign struggled amid a crowded field of candidates, lackluster funding, and a low polling despite his high name recognition, Danny.
Now, Evergrande, the world's most indebted developer, has gained a final chance to get its restructuring back on track. A Hong Kong court has pushed back a winding-up hearing to early December. Any eventual liquidation would make the company the biggest Chinese developer ever to face such a fate. Now, here in London, HSBC announced a new $3 billion buyback program despite reporting profit that missed the street's estimates. CEO Noel Quinn spoke exclusively with Bloomberg earlier today.
We've got very strong capital generation at the moment, as you can see in today's results. We've also announced when we sell our Canadian business in Q1, it's our intention to do a further special dividend in Q1 of 21 cents. And then we'll consider what we do with the remaining proceeds of that disposal. So I think we got good capital generation this year and good capital generation prospects for the next 12, 24 months as well. I think we're in a good position.
Joining us now on this is Bloomberg Finance editor Tom Metcalf. Tom, as I mentioned at the top of the show, Lori Calvasina has called it striking how pessimistic investors have been around earnings. Here you have a company that missed, but its shares are higher, less than 1%, but they are higher today. Is it just the buybacks saving HSBC?
Yeah, I think that's the big reason. I mean, by and large, it was a positive update, and what we had Quinn saying actually earlier on Bloomberg TV was, hey, some of that miss was because we were taking some hedging strategy decisions that will pay back in future. And by and large, the market today is looking at this $3 billion of buyback and also looking ahead at that 12, 24-month period Quinn was just outlining. And I think, yeah, just about a positive story, which is a rare one for banking at the moment.
Yes.
Tom, good morning. His old CFO used to say Noel went to bed happy at night so long as he was worried about costs on his behalf. Commercial property. The question is, if you look at Standard Chartered's numbers and then you look at HSBC's numbers on commercial property, do you believe or can we trust that it's a solid call by Quinn. I mean, he's got a good exposure in commercial real estate. Would you be a buyer of his call? This is the bottom of the pain in commercial real estate.
Yeah, it's really interesting just how different those two banks are coming out with on this particular matter. Standard Chartered results pretty much dominated by, the sense that, wow, there is more pain to come in Chinese commercial real estate. But again, Quinn, very, very bullish. They're not looking to take an impairment on sort of their assets in China in any great extent. And that's arguably, for me, the big difference between them and Standard Chartered this time round. It's going to be proven. He did basically call the bottom on a few calls with analysts, but I think we'll find out who was right by the fourth quarter.
I mean, I will say this for Quinn. He is a man of conviction. When he says something, for better or for worse, he is a CEO, I think, who has grown into, Danny, a formidable individual. He says, this is the way that I see it. This is my call.
Yeah, and I was just thinking the interesting contrast of him willing to call the bottom. I spoke to the Standard Chartered CFO last week, Andy Halford, who refused to call the bottom. He was like, it could be anywhere from 2 to 4 years.
Well, somewhere in the middle, there's going to be the truth. Although Andy Halford, along with his CEO, they've got some tough challenges themselves, not least how to fight off perhaps a Middle East takeover bid if it ever comes back. Just saying. Tom, thank you very much. Tom Metcalf there. A touchy subject. Tom Metcalf on the very latest HSBC numbers. Speaking of HSBC, we're going to catch up with Max Kettner, Chief Multi-Asset Strategist from HSBC for a glimpse into 2024. And we will have more from my sit-down interview with the Iranian Foreign Minister. His warning to the US if Israel-Hamas war drags on, right here on Bloomberg TV.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now, HSBC's Max Kettner is going to give us a glimpse into 2024. He writes in his most recent note, it resembles a copy-paste exercise of the outlook for 2023, a flurry of downside risks to growth resulting in elevated global recession risks, developed market central banks cutting rates, and risk asset valuations being too high. We're joined now by the man himself. It is Max Kettner. Max, thank you so much for being here. All right, there you go. A glimpse into your research, a glimpse into 2024. It's interesting because you're overweight risk right now, which, I mean, it's a fun time when that means you're a contrarian for being overweight risk. I mean, it's been a punishing few months since July. Trillions wiped off this equity market. It's a difficult week for bonds. So what heralds the return of risk?
I think what heralds us is, when we look at the market internals, perhaps a little bit of subsiding volatility in rates, right? If we look at bond market volatility, that's really explained most of the gyrations in equity multiples in particular in the last 3.5, almost 4 years now, right? Ever since the pandemic really kicked off, we've seen this big and tight correlation between equity multiples and bond market volatility on the other side. So I think, look, for me, it's not necessarily about, oh yeah, yields will have to tank 200 bips or something, right, for equity multiples to expand again, and for equities ultimately to return to, you know, a bit of upside, and also for other risk assets, right, high yield credit and so on. But to me, it's really about bond market volatility to subside, right, a bit more certainty, a bit more stability. That already could actually be sufficient for multiples to expand and ultimately then for equities to rally as well.
Max, good morning.
Yeah, let's jump
so you're not looking for 200 basis points to rejuvenate your view on risk, but in terms of, it was supposed to be the year of the bond, wasn't it? It was supposed to be the year of yield. As you go into 2024, how much, let's say, IG, HY, and sovereign, if 2024 might be a better year for bonds, where do I want to be positioned in that spectrum?
Yeah, look, I think high yield credit, if you've got a multi-asset portfolio, right, with pretty much all the liquid assets, I think high yield credit still looks really good going into 2024, right? Really good, because, and you guys were just, quoting what we said in our glimpse into 2024, and you know, I think now going into 2024, it's really unlikely that we are going to see massively different outlooks for 2024, right? Like you were saying, a year ago, it was bonds are back and the year of yield and the return of carry, or whatever they were called, the outlooks. It's really unlikely that suddenly everyone's going to be mega bullish on growth and mega bullish on risk assets and all these things, right? So most likely it's going to be pretty much more of the same, right? So then if I have a not really particularly steep maturity wall in high yield credit, if I've got earnings delivery is still pretty good, particularly in the US, yeah, I'm fine with high yield credit, right? I personally, look, I'm getting paid 9%, right? And if you look at, you look at defaults, fine, they're creeping up, right? But from extremely depressed levels, right? Okay. Then actually high yield credit is still the place to be.
Well, one of the things that confuses me is the macro data, which has been very strong, which I know underpins some of this versus what companies are saying. Just looking through the reports we've gotten, Whirlpool says that customers aren't buying big appliances as much as they were. Harley-Davidson, weak sales. Invisalign says demand for teeth straighteners are down. Botox sales are down at AbbVie. I'd like to believe that we're less vain, and that's why sales are down.
No.
Yeah, Botox sales are, it's true, Manus.
Is that a recession indicator? I don't know. Is that the ultimate recession indicator?
Is it? I thought maybe we're all coming down.
I'm not sure if that's discretionary spending or non-discretionary. I don't know.
Maybe we all over Botox coming out of COVID.
Well, clearly I'm over to you, right? Clearly, so, you know.
Max, we need the expression on your face. Don't go down the Botox route. I mean, come on. That can't be that we're all just changed our appetite for Botox. It does seem like there's a little bit of weakness, that maybe we don't want wrinkles, but we're not willing to spend up to not have wrinkles. I don't know.
Yeah. No, I'm not you will be very surprised to hear that I'm not a world-class expert on Botox spending. You'll be surprised, shocked, absolutely shocked, I know. But I guess, in terms of what companies are saying relative to the macro data, in fact, what we've been seeing the last couple of quarters was, if you look at the frequency with which companies have talked about things like recession, things like inflation, it's actually dived like crazy, right? It's really peaked sort of Q2, Q3 last year, and ever since, companies have, on aggregate, actually been a little bit more confident, right? And what we've seen, and that was a really interesting divergence, and I still think it's sort of in place now, what we've seen is that the top-down leading indicators have always been very bearish, right? And then really underpinning the sort of, oh yeah, things are going to be really grim. Whereas companies, if you look at their sentiment, the conference call sentiment on aggregate, on earnings, on margins, on their own revenues, right? The stuff that they really know about. That sentiment has actually been holding up really well in the last year and a half.
And they've been able to raise prices. And just for good order, this forehead hasn't moved much since 2015. There you go. I'll leave you with that. I'll leave you with that. That's a joke. That's a joke to the two of you. Max Kenner, thank you very much. He doesn't need Botox yet. He's too young. Max Kenner, nor does anybody else on this show. Max Kenner from HSBC, Danny Berger, my co-host every day. Let's give you a quick snapshot. The dollar could have a pretty frisky week. You've got S&P futures, equity futures rising this morning. As you just heard from Max, he still wants to take risk in there. Eroded across, you have the dollar down by 1/8 of 1% this morning. It's going to be a big week. We'll hear about the quarterly refunding this week. The Aussie is flying higher. Better retail sales, plus 0.9%, way ahead of what was estimated. Noel Quinn calls the bottom in commercial market. Dollar yen could be the absolute flyer of the week on the Bank of Japan tomorrow. Good morning from New York and London.
What did you learn in the last 40 years about leadership in politics?
Well, I've learned a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
This is Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. A story that's caught our eye, and apparently everyone's eye. This, Manus, is the most read story on the terminal this morning. Citadel's Ken Griffin has treated some 1,200 Asia-based staff and family to a 3-day celebration of the company's anniversary at Tokyo Disney. Plus, they also got performances from Maroon 5 and Calvin Harris. Griffin, of course, picked up the tab. Manus, how would you like an all-expenses trip to Disney with all of your favorite coworkers, including your favorite co-anchor, Danny Berger?
It would be excuse the pun, it would be a whole new world. I think it would be great. I mean, I just don't know, could I struggle with everybody's... Well, how many kids went on that trip? 300 kids went on that trip as well.
Something like 300.
It is Disney. I mean, can you imagine the magic of Disney? You know, it is a good laugh. It wouldn't be my preferred destination or trip, but you know what? Actually, I'd go anywhere with you, Danny Berger. There you go. I go to the end of the world with you. That's the sweetest thing you're ever going to hear out of me until we make a mistake.
That is so sweet. I'm gonna make someone clip this up, and when I invite you to Disney with me in Orlando, you're gonna have to say yes, because you've said it here on live TV.
A whole new world.
So I am expecting there to be not necessarily a wholesale adoption across the world, but we have many governments that are looking what the EU is doing and are in the process of introducing similar regulations or variants thereof. Then I think it'll be very interesting to see how these global companies will adjust their business practices. Will they implement the obligations of those regulations only with respect to Europe, or whether they do it globally? And sometimes it may be very difficult in today's conversation environment about which is more hostile or more skeptical of the big tech companies. If Facebook, for instance, cannot use targeted advertising, or Instagram cannot use targeted advertising on minors in Europe, can they then justify that they continue that very same practice in the United States and elsewhere? Because there will be many who say, well, you have ceased those activities in Europe. Don't you care about protecting our minors as well? And it is hard for reputational reasons for Facebook, for instance, then to confine its conduct and the changes it will have to make to Europe alone. So I think we will see some ramifications of those regulations outside of Europe as well.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, today on Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Crenny in New York.
And I'm Danny Berger in London. Here's what you need to know. Israel widens its ground offensive in Gaza as Prime Minister Netanyahu faces criticism for his unwillingness to accept any responsibility for the Hamas attack. Meanwhile, Iran's foreign minister warns of new fronts against the U.S. if it continues its support for Israel. HSBC announces a fresh buyback program despite announcing profits that missed estimates. CEO Noel Quinn touts capital strength in an exclusive interview with Bloomberg. And appetite for riskier assets recovers ahead of a long list of corporate reports and a slew of central bank decisions from the Fed, the BOJ, and BOE. Now, the next big earnings that come out of the U.S. is McDonald's. We're going to get Apple later in the week, but we're starting on the front foot, Manus. S&P futures are up more than 0.5%. That's, of course, after we entered a correction at the end of last week. We are on track for the worst October in 5 years. Mike Wilson over at Morgan Stanley says that the odds of a fourth quarter rally are really slim, given the market internals, given what we've seen from earnings, and just given the high expectations from the sell side for a rally. Your VIX, that is above 20 for the second consecutive week. European stocks, those are also faring better this morning. Manus up about 0.7%. We had reports from HSBC today, $3 billion worth of buyback. That's helping to give shares a lift, despite some of the concerns when it comes to the Chinese property sector.
Well, Danny, the bond markets from Europe to the United States are dealing with data. You've got German data, North Rhine-Westphalia. You've got small dip in inflation there. The U.S. bond market yields are rising again. Perhaps this is one of those defining weeks. We will find out how much the Treasury will issue in terms of 10s, in terms of 30s. We're also going to find out today the quarterly borrowing estimates. So this could be a pivotal week in terms of the flow of the bond markets. A heavy-duty issuance at the longer end could cause a significant re-steepening. Now, the crude market at the moment is down 1.72%. It believes in the perhaps slower pace and the containment within the Middle East. We're going to sit down with Bobby Ghosh very shortly and hear from my conversation with the Iranian foreign minister. Right now, the oil market is presuming on containment of this Middle East conflict between Hamas and Israel, and it may not cross any other borders. That may change in the ensuing days. If you wanted your hedge or your choice of hedges, it was the gold market up 9%. We're down at the moment 0.5%. Again, the hedge funds are shifting their position on the gold market as well. This really was one of the key planks of hedging since October the 7th. Danny, good morning.
Good morning, Manus. And we were just talking with Max Kettner over at HSBC, who is bullish on equities, Max bullish on high yield. I tried to sort of prod him and get him to talk about the fear of recession because Botox sales are down, which surely must be a bad sign. But he said, look, Danny and Manus, the mention of recession itself on earnings calls already peaked. So in that view, what we're hearing on the micro side isn't that different from the strong macro data.
No, it depends on how you want to be set up into 2024 and whether you really believe you have run the course with these bond yields on the upside. Our top story this morning, Danny, is, of course, around Israel. And the tensions there and in the Middle East are escalating as Israel steps up its offensive on Gaza. This comes as Iran warns of new fronts against the U.S. if this war drags on. I sat down with the Iranian foreign minister on Friday. Let's take a listen.
As long
as the Syrian government, in order to fight against terrorism, they ask us for help, and within the framework of our defense cooperation, we will act.
Are you scaling up your troops to Syria? Are you sending more? Right now.
If it entails, I mean, if fighting against the terrorism, for that, the Syrian government asked us to do that, and we already have.
Have they asked you for more troops? You already have.
Yeah, when they were fighting ISIS, Syria asked us.
I'm talking about since October the 7th.
And we acted upon that.
Have you sent more troops since October the 7th to Syria?
No, I don't think so.
The Gulf? Are you sending more naval vessels to the Gulf?
Are you putting me on trial or interviewing me?
No, I am trying to understand, respectfully, Minister, I'm trying to understand the difference between, I suppose, escalation and de-escalation. And I think the world wants to understand where you are in terms of your assets.
After the 7th of October, how many weapons, American troops and weapons have been sent to Tel Aviv? Can you give me the number? How many aircrafts, trucks, what kind of weapons?
You are the foreign minister. I would expect you, sir, to have access to that information. I am simply a journalist. I'm trying to understand for our Bloomberg audience what the state of play is in the world. And with that in mind, sir, you have obviously been very critical of these additional troops and additional deployments to the region. And I want to understand, for example, you have a great influence as a nation over the trade routes of the world, in the Persian Gulf, in the Red Sea. What our audience will want to know, will you be a protector of those trade lines or a disruptor? That's what I'm trying to get an answer to.
ما نیروی جدیدی
We have not dispatched any new forces, any new troops to neither Syria nor Iraq or to other parts of the region. But we are not just like onlookers. We have not just been watching the developments. Any time that we think is necessary, proportionate to, and in accordance with our national interest and situation of the region, at the right time and place, the Islamic Republic of Iran will make the decision. But I would like to warn right here that the continuation of the situation, the continuation of the killing of the people in Gaza and women and children will make the situation get out of control in the region.
That was Iran's foreign minister with me in New York on Friday evening. Joining us now in studio is Bobby Ghosh, our Bloomberg opinion columnist. Bobby, good of you to join Danny and I this morning. We're trying to understand the state of play. A great deal is happening. He was warning about the U.S. backing of Israel, that undivided backing. I did push him in terms of, are you warning the people of the United States of America in country? He was very clear, a major escalation of this war would open on all fronts for him. Of course, you've got to ask yourself what strength and control he still has with Hezbollah and Hamas. Where are we in terms of the global geopolitics for Israel? Good morning.
Morning, and thanks for having me. Well, you know, I was watching that clip with interest. The most charitable thing you can say about the foreign minister of Iran is that he was being disingenuous. Iran does not fight directly against Israel. It uses an assortment of different Arab proxies. Iran is quite happy to fight Israel until the last Arab. That's been true for a couple of decades now. The fact that every so often an Iranian official comes up and warns about the escalation and expansion of the conflict should be taken very seriously.
But that's how they deliver terror, isn't it?
Exactly
that is the personification of terror.
That's exactly right. They use terror groups like Hamas, like Hezbollah, the Houthis, the Shiite groups in Iraq, and they have already been ratcheting up the activities of these groups. There have been missiles being fired all the way from Yemen to Israel. So it's one thing for him to say we're not sending more forces. The whole trick is they don't have to send more forces. They have local proxies that they have cultivated, trained, armed, financed for decades that they can use to deploy whenever it suits them.
So Bobby, and great to see you this morning. So when he talks about the U.S.'s involvement, saying things like the U.S. Is running the war, and the threats he expressed with Manis and earlier on about the U.S. should back away from their involvement or face that kind of escalation. Is that threat then more concentrated on, you say, is those sort of proxy groups or something more direct, something more, I don't know, pernicious between directly Iran and the U.S.? Should we make that of those types of threats?
No, I think the use of proxy groups is the most pernicious part of it, because the Iranians can always use somebody else's shoulders from which to fire at the United States, and whether it's directly against U.S. targets or the targets of U.S. allies in the region. Israel, of course, the UAE, Saudi Arabia. There are plenty of points in the Middle East that Iran can attack and hurt the United States, hurt our allies, and hurt the global economy. This has been the threat that Iran has posed for many, many years, and that has not changed. I can't imagine that Iran will directly get involved in this fight, because whenever they have done so, it has been to great cost to the Iranian people and the Iranian nation. And as long as they have other people to do their fighting, why bother get involved directly?
Well, we did actually touch on his visit to Qatar, the $6 billion, the hostage exchange. We touched on his lobbying, in theory, with Hamas to release the civilian hostages, and that came up a couple of weeks ago in Qatar. Can we just pivot to the U.S. side? We have funding. We have a new Speaker of the House. Therefore, we will see an accelerated program on war funding, defense funding for Israel and Ukraine. But it looks as if, in the first instance, that this is going to be split in two. What size of funding and how important a message is that to the world that America stands with Israel but not with Ukraine in terms of funding? Because that is the takeaway message if the funding is split.
That is how the rest of the world will see it, and that is how the White House...
Russia will see it.
And Russia, and that's how the White House would like the rest of the world to see it. I mean, this framing of putting the Ukrainian funding and the Israeli funding together in one, this is President Biden's framing. You remember the speech from last week in which he put these two things together. He made the argument that these are part of a continuum, that these are part of threats to the United States that need to be looked at as a whole rather than individually. So yes, there will be a perception outside of the U.S. that there is a softening of America's support for Ukraine. This comes at a particularly bad time. The big question is whether the Europeans step up and increase their support for Ukraine, whether that burden, if you like, can be shared with European allies, other NATO allies, where they take up the sort of heavy load of supporting Ukraine while the United States, for a little time anyway, supports Israel.
Bobby, on the ground in Israel and in Gaza, the way that's been characterized of the current approach is instead of a massive ground invasion, a slower, day by day, taking it an approach based on casualties. The market has interpreted that approach one way as de-escalation seeming to play itself through these oil markets. But does that kind of approach change the narrative at all of Israel's war against Hamas?
Oh, I'm afraid that events on the ground are moving too quickly for us to take a sort of safe position on that. If I were sort of in the oil futures business, I would not be so sanguine. I think events are changing even as we speak. It has been remarkable that Israel has not gone in, that sort of ground invasion that we've been expecting for 3 weeks has not yet taken place. But I can't imagine that
Do you think Netanyahu still has the global support for that open-ended global support?
No, he has not. A lot of that support that we saw in the first few days after the October 7th attack has sort of faded away. But he still has substantial support within Israel. There's an appetite within Israel for vengeance, for a reckoning on what happened on the 2nd of October, and that's going to guide his actions more than anything else.
Okay, Bobby, thank you so much getting up early this Monday morning to give us the context on the Hamas-Israel war. Bobby Ghosh, Bloomberg opinion columnist. You can pick up his opinion on the Bloomberg terminal. Coming up with Danny and myself, brace, brace, brace. Heck of a week. Jolts, jobs, refunding, all to play for in the bond and equity markets right here on Bloomberg.
Season is here.
Tons going on, lots of earnings. Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need to we need investment support because we are the best investment case for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Brief with Danny Berger in London, Manus Cranny in New York. And the bond market has a lot to digest this week. The BOJ is going to kick off a string of rate decisions tomorrow. And here's what Bloomberg opinion columnist Mohamed El-Arian said on the Bank of Japan's YCC. He wrote that while there is no guarantee that the central bank will be able to chart an orderly exit, it runs a greater risk of fueling unsettling volatility by maintaining the current overly measured approach and calls for them to exit YCC. Joining us now is Bloomberg and Live cross-asset strategist Ven Ram. Ven, it makes sense what El-Arian is talking about, the distortion caused by YCC, but does the Bank of Japan really care about the wider bond market distortion, or are they just going to focus on their inflation targets for any adjustment when it comes to YCC and wider monetary policy?
I think El-Arian has got a fantastic point there. I do think that the Bank of Japan is going to increasingly feel the pressure if they continue to keep the yields contained at the current point, because you've got 10-year Treasury yield surging past around 5%, hovering around 5%, and you've got less than 1% yield on the JGB. That's not tenable in the long run at all. And the BOJ is kind of acutely aware of it, because they've been coming into the bond market to defend the curve control on quite a number of occasions this month, and they can't continue with it for the simple reason with corporate bond spreads tend to blow out, and then corporates can't come into the market and issue new bonds. So all that causes market dislocation, and that at some point the BOJ will think that you know what, it's not worth defending the bond market here to the point where market dislocations begin to widen out. So I think that the Bank of Japan is acutely aware of that. The question is when, though. I don't think they will do anything on negative rates this week, but we may get some kind of modification of the permissible range on which 10-year yields can trade.
Ben, good to see you. I think if they do anything at all on yield curve control, it'll be like just ripping a big vacuum cleaner, and it'll just suck a huge amount of liquidity. That's just me. What about this quarterly refunding from the Fed? I've got BMO telling us that it's going to be the most significant moment for the bond market. Never mind your FOMC, never mind your jobs report. It's going to be all about the Treasury refunding. Do you agree it's going to be that capacity to usurp the other data points?
Yes, I do think that there's a fair bit of argument to be made in favor of the Treasury refunding announcement being the more important thing, because at least this week, because the Fed is going to be on hold. They're not going to raise rates anymore at this point. They're quite restrictive enough. The other point is that yes, we get the labor market data. We've already known that the labor market is pretty strong. We already know that the jobless rate is only 3.8%. The Fed thinks that they need a jobless rate of 4.2, 4.3% to nudge the labor market into balance, and we are not going to get that any point soon. So with those two known unknowns already there, the only other point of interest for the markets is the refunding announcement. And we just got the deficit figures last week, and that was a doubling of the deficit. And we also got the GDP numbers last week, 4.9%. That's fantastic growth. So if you look at all those things, the next focus for the markets is how much more is the Treasury going to issue to defend this deficit.
And then the MLI poll survey released over the weekend has a search for that ever looked for neutral rate, and it has it doubling at least 100 basis points, again, according to respondents, from the pre-pandemic levels. What's the impact of that? Because that doesn't seem like something that's been fully digested or at least attempted to be digested in this market.
Absolutely. I think that's being underappreciated by the markets to a large extent. And that's why so many portfolio positioning, so much of portfolio positioning has gone all right this year, simply because people haven't grasped the truth, the reality of the neutral rate. If the neutral rate is higher, real yields are going to be higher as well. And we have seen real rates go from, the 10-year real rate in the US has gone from 0 to 240 basis points at the moment as we speak. That's a phenomenal surge by any stretch of imagination, and if that continues, nominal rates are going to go higher as well, which is why, despite all the tensions in the Middle East, we haven't really seen the 10-year treasuries or the 30-year treasuries rally despite all the tensions, and I think that there is a message for the markets that they are still underappreciating.
Okay, well, let's see that Treasury funding announcement on where it is on the 10s and 30s will be irksome, one could say, to the yields. Sven, always good to get you with us. Sven Ram, our Bloomberg Live team. Coming up, I look at some of the market-moving events to watch out for this week. You're going to get that Treasury funding. You're going to get the jolts. You're going to get the jobs report. S&P futures trying to claw their way back. We went into correction on the SPOOs, correction on the NASDAQ. The dollar's down by an eighth of 1%. As the equity markets has decided in its infinite wisdom at 5:51 a.m. to be risk on. Will that endure is the question. Oil is down on containment hopes rather than fact in the conflict in Israel-Hamas war. Right here on Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Your grandfather was a famous basketball player. In fact, he's in the Basketball Hall of Fame. Did you have any of his basketball genes?
You know, in my family, David, you didn't do very well at the family barbecues if you couldn't play hoops.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Cranny in New York. Now let's get you set up for your trading day with a look at what's ahead this week. It is a big week of central bank decisions. It's going to kick off with the BOJ on Tuesday, then the Fed on Wednesday, and the BOE on Thursday. Plus, is the quarterly refunding announcement going to be the big one, of course, from the U.S. Treasury? It comes just hours ahead of the Fed's rate decision on Wednesday. And finally, Manis, we're going to round out the week with Apple earnings on Thursday, and then we get the U.S. jobs report on Friday. But first, we have McDonald's earnings today. You fancy yourself a bit of fast food, Manis?
I get dropped off outside McDonald's every morning. I've got to say, around the corner from here. But I come in and I have my low-fat yogurt and berries at 2:32 a.m. in the morning. There you go.
Too early for McDonald's.
It's too early for anybody to know what we have for breakfast at 2:30 in the morning. Of course, we've got to keep an eye on the UAW and, whatever resolution there may be in the United States of America, it's crosses borders. Stellantis workers in Canada, Danny, they're on strike. Talks fail. Ford's deal includes $8 billion in plant investments, according to the UAW. But north of the border is where you want to really keep an eye on. Danny, revert back to the oil market. I mean, we're down $1.18 at the moment. And I think that this is where we're going to really focus in. So right now, the oil market believes that there's a limited and targeted approach by Israel. It seems to have gone into this quasi-state of not pause, but a less significant all-out ground offensive that was originally anticipated. And the Bloomberg survey says the Saudis will pause their price hikes.
Right, but we're just speaking with Bobby Ghosh of Bloomberg Opinion, who says if he was an oil trader, he wouldn't want to be making that bet, just given how quickly things change day to day on the ground. All right, that's it for us on Brief. Surveillance up ahead.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The it is our sense that something fundamental is going on.
We think it is a buying opportunity for the market.
People are making more money. They're feeling very depressed about inflation, but they're still spending.
There's a lot of issues right now that are somewhat inflationary.
Volatility is going to persist until we have a clear inflection in the direction of the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This really may be the most important week of the year. Good morning. Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz, Tom and John still on their cruise. They are enjoying the twirly slide. They're going to stay for another day. I bribed some of our favorites to come back and be alongside us, Damian Sassower and Gina Martin-Adams. We are so lucky to have you share your insights on a day of incredible import, heading into a week of incredible import. I want to start, Gina, just by what we're expecting to be the most important on a week where we get Apple earnings, we get the Treasury refinancing agreement, and we get central banks galore.
Well, you name it. There's just too many things to cover. But I do think Apple earnings are probably the most important thing to watch within the S&P 500 for the extent to which tech stocks can specifically continue to carry the index. We have seen earnings generally beat expectations, but some uncertainty around the outlook with respect to the dollar, with respect to what's happening at the 10-year seems to be really weighing on stocks. So Apple could still help to sort of keep some stability in stocks.
Damian, I imagine that you're watching things outside of Apple.
Do you think that the quarterly refunding announcement can actually be more important than the Fed?
That's what everybody's saying.
I think so, yeah. I mean, absolutely, right? But I mean, for me, I'm an emerging markets guy, so I'm looking at central bank activity in places like Brazil, Czech, Malaysia, you name it, and it's important stuff because we're going to see how they respond to some of the recent weakness in their economies. Are they going to continue to try and cut rates in the face of their currencies coming under pressure via King Dollar? I'm not so sure they can.
I'm glad that you mentioned this because it's not just the big majors that we're going to get central bank decisions from. It's all around the world coming out to give a sense of the state of play of where we are. And it's coming at a time of incredible uncertainty. And we saw this expansion of the ground operation in Israel heading into Gaza. Why do you think, Damian, the markets are so sanguine about it?
Well, you're right. I mean, oil and gold are coming off here. That haven bid's kind of declining. And I think it does have to do with the uncertainty over the central banks this week, right? I mean, the focus does shift to the Fed. It does shift to fixed income, in my opinion. We have Apple earnings, but, you know, we're pretty much through a lot of the earnings cycle here. And I think now that we've seen the NASDAQ and the S&P kind of crash through their 200-day moving averages, or at least kind of come below it, I don't know if it's time to buy this dip, but certainly people seem to be sitting on their hands here.
Yeah, and I wouldn't say the equity markets are sanguine at all. Small caps made a new low right, last week as of the close on Friday. Small caps are below their 2022 lows, which is pretty consequential for risk tolerance. If you think small caps, emerging market equities are generally the leaders of risk tolerance in the broader markets, looking at the S&P 500 breakdown doesn't tell you the whole story. And I do think that stocks are completely breaking down amidst all of this action.
Let's get to stocks because our next guest has a lot of insight just on this. You are seeing a buy the dip kind of moment, particularly led by the NASDAQ. Once again, S&P futures up 0.7%, 4164, although poised for the third straight monthly decline, which is unusual. Euro gaining just a touch, 10-year yields inflecting upward, but still well below that 5% mark, 4.86%. Crude off. Again, this goes to the haven bid, this question of why are people relatively sanguine about the idea of escalation when there kind of have been some escalatory moves and words coming up for this week. We've been talking about how important this week is. We get the Bank of Japan rate decision on Tuesday. Will they drop yield curve control? The Fed on Wednesday, does it even matter based on the Treasury refinance agreement, and Bank of England on Thursday, as well as a host of emerging markets, which Damian will remind us of pretty much every hour on the hour. Throughout the week, on the economic data front, we get U.S. employment cost index on Tuesday, U.S. job openings on Wednesday, U.S. initial jobless claims and productivity on Thursday, all leading up to the big event, which is the U.S. employment report on Friday. Gina, does it matter?
Yeah, it does matter. I do think that ultimately what we're looking at is stability in the economy, which is creating some degree of earnings recovery amidst a slowdown in inflation. And that is at least half of the equation for what drives stocks. I realize that over the last 6 weeks, we've been completely captivated by the macro, and it's all about rates, and it's all about what central banks doing. But ultimately, it is about that long-term cash flow growth, that long-term earnings growth. And if you have a stable economy, you have consistent spending in that economy, some of the recession worries really get put to bed.
I like that we're going to be having balance sheet discussions about Apple and about other companies. We are going to get Apple on Thursday. On Wednesday, we get another financial discussion, which is the Treasury refunding announcement, as you mentioned. Damien, a lot of people are saying it does take precedence over almost everything else. To me, I think it's going to be most interesting to understand how bonds and stocks respond to some of these particular economic and other data points. That, to me, is going to be the big mystery.
And the dollar. And the dollar. How's the dollar going to respond to that QRA? I mean, the dollar and its sensitivity to the long end of the U.S. yield curve, forget about twos, I'm talking 10s and 30s, has been as tight as you've seen in recent months. And so I'm definitely looking at the QRA. I mean, I think the street expects it to go up from here, certainly. It's the extent by how much. And so I think that's really where the rubber meets the road for me.
So let's get right to it, because this really is a question of, is the headline figure is really masking the underlying pain that Gina was just talking about, that stocks really aren't holding up. Lori Calvasina joining, head of U.S. equity strategy at RBC Capital Markets. Do you agree with that when you look under the hood, you're seeing massive breakdowns that are reflective of a great deal of pain that people really gloss over?
I think that's fair, Lisa. I mean, I think Gina hit the nail on the head when she talked about small caps making a new low. I always tell people about small caps, even if you can't buy them, they tell you a lot about what's going on in the broader market. And I think what's going on is that they're really taking the brunt of the pain as regards to the big increase in 10-year yields that we've seen. Now, of course, the tech stocks and the big cap part of the market are getting knocked around by that as well. But small caps, it doesn't matter to how many charts I can show people suggesting that the balance sheets are not that bad. People simply don't want to hear it. And there's a view that small caps are simply not going to be able to weather the storm that's created by the surge in interest rates, whether it's 10-year yields or Fed funds. And again, I have so many charts, Lisa, that I've been showing people for the last 6 months saying, hey, small caps have done a good job of shifting towards long-term debt. The variable rate's down. The weighted average maturities are really not that bad, on average about 4.5 years. People simply don't want to hear it, Lisa. There's just been a long adage that small caps don't weather higher interest rates very well. And I think that's one of the big reasons why they're getting punished right now.
Lori, can you talk about sector performance within the small cap sectors? Because I do think that the sectors are telling an interesting tale in small caps that maybe we're not picking up in large caps.
So if you think about, think about it from a valuation perspective, I will say that most sectors in small cap look cheap relative to their large cap counterparts. But where it gets really interesting is on some of the cyclical sectors. So it's not just small cap financials that are dragging down the Russell 2000 from a valuation perspective. Healthy sectors from a fundamental perspective, like industrials, also look pretty cheap relative to large cap in the small cap space. Consumer discretionary stocks really look kind of left for dead. If you look at valuations there, they're deeply, deeply cheap, and they were actually really down around recession-type lows last summer. So we're really seeing that pain very, very widespread.
And given we are in the midst of earnings season, is there anything that you're getting out of earnings that maybe is not getting picked up by the markets, considering the markets are so captivated by what's happening in these macro indicators?
So I think people are really misunderstanding what's going on with inflation moderating and what that does to companies. One of the things that we've seen when we compare our numbers versus the street consensus, and we actually, we use the Bloomberg data to monitor the street consensus, and it does a really good job of articulating how margin expansion is baked into a number of different sectors next year. Well, in my modeling, we actually don't have margin expansion. We kind of have margins going back to 2022 type levels. And one of the reasons why is that we don't give margins a big benefit from sliding inflation. We simply haven't seen a justification to do that in our back test. And when you go through all the transcripts, what we're really noticing is that companies are picking up on this. So the pricing discussion has simply gotten much, much squishier, and companies are saying it's going to be a softer pricing environment. Of course, there are a couple that are out there saying they're going to raise prices to infinity and beyond. That's not really the norm here. And what we're really seeing is that companies are acknowledging that they're not going to have an excuse to push these prices through as the cost environment moderates. And so we're not, going to necessarily see this big boom to margin expansion simply from costs coming down and prices staying high. And I think that's really what's embedded in a lot of street assumptions for next year.
Lori, I'd like to build on what Gina was referring to about sectors, and specifically sector dispersion amongst large cap names, right? I mean, it's usually at its highest during periods of distress. I'm thinking 2000, 2008, yet sector dispersion has been very high since the pandemic started. I mean, I wonder what you take from that. I mean, certainly we look at some of the interest rate sensitive sectors and how they've underperformed. I mean, is that going to continue? I mean, what's it going to take to kind of get these correlations to right way?
So I'll tell you, Damien, what I feel like I've noticed in the sector data over the last couple months, and this is looking at the S&P 500 specifically, but it feels like anytime there's a part of the market that gets a little bit of leadership, it can't sustain it for that long. And I've described it as, sort of this sniper that goes out. Anything good we have just gets taken away. And we saw, utilities, for example, was having a really nice moment late in the summer, and then all of a sudden just the bottom fell out. Yeah. We've also seen energy just really kind of lose that luster. And I think the problem is that the market is losing confidence in any one narrative. We really can't get a rotation going because on the one hand, tech stocks look expensive, they look crowded, their earnings dominance is starting to fade, and hey, interest rates are not usually a good thing for those stocks, so that's starting to take a toll. But anything the market wants to rotate into just can't seem to maintain its footing for all that long from a fundamental perspective either. So it's just been a real struggle, I think, both to find something to generate incremental excitement in the market and to really allow that rotation to play out.
Well, Lori, I'm so happy you mentioned utilities because it's been utilities and consumer staples, those traditionally low beta defensive sectors that have underperformed. I'm wondering, how do you position defensively in today's market?
So I think it's very tough. I've actually got an underweight on consumer staples. I'm neutral on utilities. I'm overweight healthcare. That one's had a tough time getting going as well. But to me, it's got the nicest combination of decent valuations. At least until recently, it's had strong earnings revision trends. We've seen the med tech space sort of take a little bit of a hit, and there's been a concern about the weight loss drugs that emerged. I've been trying to tell people that happened at a time when the med tech stocks looked like they were kind of over their skis from an earnings revision perspective anyway. But if you look in other areas like pharma biotech, if you look at the providers and services space, you have a really nice kind of ramp up in earnings revision trends that feels like it has more room to run. It's not a perfect story by any stretch, but other than the weight loss drugs, it does feel like it has less macro hair than, say, utilities and staples. With staples, I will tell you my analyst is starting to feel a little bit better there, just based on the fact that we did have this big sell-off from the weight loss drugs. And valuations, I will admit to you, are pretty compelling, but I do continue to worry about that sector from just a pricing perspective. I think it's right at the sort of center of the storm I mentioned in terms of not being able to pass through higher prices for much longer. We're seeing those companies actually really talk about how consumers are pushing back.
Lori, what does it tell you that you can have the right idea in terms of the solidness of a corporate balance sheet, that you can have the right idea about historical valuation, and that investors just won't bite, that it doesn't actually work in trading practice?
I think it tells you that, whether it's the Middle East, whether it's interest rates, we're in a sentiment-driven market at this point in time, and confidence is just very, very fragile. One of the things we've talked about, Lisa, a lot this year is how 2022, 2023 has felt a lot like 2010, 2011, and 2002, 2003, which were kind of messy, extended post-crisis normalization periods. I lived through both of those as a strategist, and what we saw was that confidence was just very fragile. There was a constant fear of the next skeleton coming out of the closet and blowing things up. Constant fear of tipping into another economic downturn. And I think that's the environment we've been in recently. And so anytime we have issues that come up, there's just not a lot of confidence that either companies or management teams or the market as a whole or the economy is going to be able to weather the storm. And that kind of felt like it was easing over the summer, but I feel like we're getting sucked right back into that messy normalization period again where confidence is low.
Lori Calvasino of RBC Capital Markets, thank you so much for being with us. Would you agree with that, Gina, that basically that seems to be the sort of sentiment messiness that's actually a recovery, not the opposite?
Yeah, I do think that that's pretty consequential or pretty consistent with what we see right after recession experiences, with the one exception that inflation conditions have been so profound in this cycle, where we didn't really have to worry about a reacceleration in inflation. We didn't have to worry about inflation's impact on earnings in either of the post-recession recoveries of the last two cycles. That's been characteristically pretty important, and that's what, in my opinion, is driving that sector dispersion that Damien mentioned. Is just this inflation story is creating really different sector-level outcomes, which is creating different outcomes for the market at large.
Well, Gina, I think it's the leverage factor, and you've written to this previously, right? The reason those defensive sectors are performing so badly is because they have high leverage.
Yeah, it makes a huge difference with rates moving as they are, and I think rates are moving because of inflation.
It's complicated. Maybe we just say that. It's a complicated brew. Coming up at 7 a.m. to parse through the complications, Barry Bannister of Stifel, as we drive forward on a crucial week for markets.
Times and global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank, and I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Let the Israeli Defense Forces speak to their plan, and war, of course, is highly unpredictable, so it's difficult to predict how it will play out. We will continue to talk to our Israeli counterparts. We'll continue to ask hard questions about how they are thinking this through, how they are proceeding, but ultimately these are their decisions. If American troops are attacked by Iran and its proxies, we will respond. We did respond. If attacks continue, we will respond.
That was Jake Sullivan, U.S. National Security Advisor, speaking on ABC, flooding the networks over the weekend. We got a number of different insights. And honestly, I am just as confused as I was before. It's very unclear what's going on in the Middle East. Let's get straight to it. Bloomberg's Ali Crook took a plane back to Tel Aviv to help us out, to understand what's happening on the ground. Ali, can you just start there? We do know that the ground operation has been extended. It isn't necessarily considered the same kind of scale that people had expected. What do we know about what's going on?
Yeah, that's right, Lisa. So now we're in the fourth week of this war, and really a new chapter or a new stage, as Benjamin Netanyahu called it over the weekend. And what is this new stage defined by? Really by a growing ground presence of Israeli troops within Gaza. So we saw the greatest sort of, effort on their part so far. There had been sort of puncture wounds in and outs that had been happening, but really this weekend with tanks in there and that offensive expanding. And we've heard from the IDF, they said over the last few hours there have been more and more troops that have entered. They're going about this very gradually, as they had been sort of trying to destroy the idea that it would be a full land invasion, which this is not quite yet. And then the question is, why are they going about it this way? Of course, there's the more than 200 hostages that are still being held by Hamas, but then there's the very real escalation risk. There has been some condemnation from some of the Arab nations about this step up. There is some more fighting on the border with Lebanon, but nothing really outside of what we've seen previously, and some strikes within Syria as well. What we will be keeping an eye on, however, in terms of looking at the risks of escalation, is some more and more clashes in the West Bank. This is going to be key. And also, we understand from Lebanese television that we will be hearing from the leader of Hezbollah on Friday. He will speak on TV publicly for the first time since the war began.
Ali, we'll catch up with you next hour, and we'll go more in depth about that as well as the politics in Israel. Thank you so much for being with us. Bloomberg's Oliver Crook. I want to pick up on the point that Ali was talking about with respect to Hezbollah, why they haven't gotten more involved, when they might get more involved. Joining us is Norman Rule, former U.S. senior intelligence official and senior advisor at the CSIS Transnational Threats Project. And I want to start there, Norm. I mean, how much are you sort of, I don't want to say surprised, but is it unexpected that Hezbollah has not gotten more aggressive when it seems like Israel is sort of tiptoeing into the ground invasion they've been talking about?
Good morning. I don't think it's a surprise that Lebanese Hezbollah has not responded more aggressively. We need to keep in mind that for Lebanese Hezbollah, they're still fighting a conflict in Syria. They've lost many of their best personnel in Syria. Lebanon is in a political shambles, and the economy of Lebanon has been halved in recent years. So it's a quite poor economic and political situation. For them to enter the conflict, they would need some sort of gravity pull of events or actions to cause them to risk so much, especially since Israel is alert looking in their direction and has augmented military forces in that area. So for Hezbollah, this would be a very daunting and risky operation for unclear strategic goals.
Norman, Israel's relationship with the Middle East, with the broader Middle East, as we know, is in complete disarray. But Brazil, Turkey, Colombia, other major players, Israel's relationship with them is deteriorating as well. The United Nations, for example, is Israel losing the foreign policy battle here?
Well, Israel's certainly losing the public diplomacy aspect of this conflict, and that's not unsurprising given the international sympathy for the plight of the Palestinians. But I would be careful in saying that this would be a long-term impact on its trade and diplomatic relations outside of the region, at least at this point in the war.
Prior to the attack by Hamas, Israeli politics had been very divisive, obviously. What are your thoughts on Bibi's ability to remain in power, given the ground invasion and all that's happening now?
It's very challenging. In 1973, the conflict ultimately helped propel Prime Minister Golda Meir out of office. And the investigative commission at that time, the Agramat Commission, didn't really do much to help her stay in power. The investigation after this will be even worse. He's only been popular because he has stated that he would be the security prime minister, would prevent an attack. And for this reason, I think many Israelis put up with the divisiveness and the turbulence. That's now, that idea has now been erased. So I think his political survival is very, very much in doubt.
Could we talk a moment about the U.S. response, and in particular the new sanctions put in place on Friday? Where do you see this headed, and how are these sanctions potentially impactful?
Well, I think the U.S. response has been measured. There's a deep sense in Washington that we don't want to be pulled into this conflict, to include having our reputation and our equities in the broader region pulled into the anger that is felt in the Arab street against Israel. It's a very delicate time. I would be careful about looking at sanctions as having too much of an impact on the various adversaries at this time. You really have to ask yourself, when you look at a specific sanction, does this touch the decision maker at the top of the pyramid of an adversary? And the sanctions that have been put in place against Hamas recently are important, but don't really meet that measure.
There's a real question, Norman, about how much Qatar, how much Saudi Arabia are playing, how much they're playing roles behind the scenes that we don't know about. We know that Saudi Arabia's defense minister is coming to the United States to meet with the White House this week. That has been reported by Axios. What do you make of that?
Saudi Arabia and the United Arab Emirates and Qatar have each played large roles in recent weeks. Saudi Arabia and the Emirates have done what they can to tamp down anger in the region. The United Arab Emirates has actually made some statements in sympathy of Israel for the terrific attacks on October 7th. The Saudi defense minister's visit is probably related to several things. He's going to ask for a sense of where Washington sees the conflict going. How does Washington plan for the day after, the diplomacy for a two-state solution, and defensive issues to allow Saudi Arabia to augment its capacity to push back on Houthi missile activity, and perhaps Houthi border incursions against Saudi Arabia.
Based on what you've seen over the weekend, and it seems like there have been a lot of events, are you more optimistic or less optimistic about the potential for a neater resolution in the near term than you were last week when we talked about the same issue?
I see no changes. The resolution both to this conflict and the Arab-Israeli rapprochement are both unclear, and it's going to take a fair amount of time to play out. I will say that the Gulf states have communicated quietly that they remain highly interested in rapprochement with Israel, but obviously the timeline is thrown aside at this point, and no one really talks about when that diplomacy can be restored, given the state of the conflict.
Norman Rule, thank you so much for being with us. We look forward to speaking with you again soon. Norman Rule of the CSIS Transnational Threats Project. And Gina, honestly, I think that your question about the U.S. response is a really important one, especially because Biden's gotten a lot of pushback, even with his own party.
Right. And also there's so much question as to what the U.S. commitment is globally to sort of resolving geopolitical crisis in general right now, considering our budget deficit situation, which also ties right back to financial markets, the budget deficit being pretty important consideration. Will we be able to commit to defense spending to support the world and peace throughout the world, or are we going to have to sort of become more insular? And that seems to be the continuous trend over time as we have this larger deficit.
I'm curious what the majority of views for U.S. Republicans and Democrats are on the war. Like, I mean, if you're an average Republican in the United States, what's your position on a two-state solution? Same for a Democrat. Like, I just don't think there's a lot of clarity there, and I think our political leaders don't really know how to support their constituency on it. So I think there's a lot of ambiguity there.
That was doing a lot of heavy lifting, how to support their constituency in terms of just how divisive this issue has become.
Exactly.
And what we saw from the new House Speaker, Mike Johnson, over the weekend when he went on Fox News was actually something of a neocon position. It was actually more traditional. We need to back Israel. We need to do support. But, oh, yeah, we also need to do budget cuts, to your point.
Right.
And we got to take it out from somewhere.
And on top of Ukraine, Russia, which is also a highly controversial topic in Congress right now.
Ian Bremmer keeps putting out on X, the platform formerly known as Twitter, no one's asked me about Ukraine. 3 weeks.
Yeah.
Nobody. And that, I think, is
very
telling.
suspicious.
Well, I mean, it sort of speaks to the mood. Coming up, we're going to talk about the latest in the economy on a key economic week. Francis Donald of Manulife Investment Management. That's next.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
little lift after we saw last week corrections in both the NASDAQ and the S&P. We can see a bit of a bid to the tape. Welcome back. This is Bloomberg Surveillance. John and Tom are both still on their cruise. They are enjoying drinks on the deck. No, they are not, but they will be back later this week. I am so glad to say Gina Martin-Adams and Damian Sassow are alongside me, which is a wonderful thing on a massive week. The euro getting a bit of a bid, and yields, Damian. Honestly, to me, this is sort of the big mystery of every day. We come in, what adventure are we going to get today? What you see on the screen is no indication of what's going to happen in 3 hours.
That's right. And look, I mean, we always laugh about fundamentals in this environment. I mean, U.S. fundamentals obviously have been strengthening. In Europe, you're seeing it go the other way. What's interesting, we're going to get some data tonight from China, right, which has been historically a weak spot here. So I'm curious to see what the PMI data tells us. Obviously, people think it's going to be weak. I mean, if you just look at, they had a holiday earlier in the month, so it's probably going to weigh on things. But, you know, China's a real problem spot. Nobody's talking about that either.
No one's talking about that. No one's talking about Ukraine. No one's talking about all sorts of things because we all have a fatigue with everything that's going on. Where do you look next? Let's get straight to it. And I'd love your thoughts on just that sort of overhang and how it just creates a fog that's difficult to get out from under. Under surveillance this morning, Israel expanding its ground offensive into Gaza in what leaders are calling the second phase of its war against Hamas. President Biden speaking to Israeli Prime Minister Benjamin Netanyahu over the weekend, telling him to prioritize the protection of civilians. Concerns are growing over the scale of the humanitarian crisis in Gaza. The UN saying 33 trucks carrying aid crossed into the territory on Sunday, the most since the conflict began. And honestly, it is so hard, Gina, to get a handle on where to look next and how far this is dividing people and how much this is going to affect not only the budget, but also the political landscape at a time where we're not sure what party is which.
Yeah, it is incredibly confusing, and it's one of many, many factors impacting the markets. I think this is the other trouble, is it's easy to get captivated and sucked in by this particular issue, considering the human consequences, the potential international consequences of this war. At the same time, though, it's pretty clear to me that equities are the only market that's still paying attention, right? Dollars stopped rising in early October. Long-term Treasury bonds stopped rising in mid-October. Equities are still melting down. So that tells you a lot about risk tolerance. It really is about now an adjustment of risk premiums as equities are certainly paying attention to the global markets, despite the fact that earnings are beating expectations. So even though the U.S. economy is still somewhat stable, recession risks are somewhat limited relative to expectations. These global considerations are elevating risk premiums.
Well, Gene, I'll do you one up. It's not just equities, it's credit spreads also, right? But it's not investment-grade credit spreads. It's high-yield spreads, which are finally gapping wider here. And emerging market, obviously, sovereign credit spreads have been doing that for some time. So, you know, if you want to look for some sense of where investor sentiment is, look no further than equities and spreads.
Well, this is sort of a question of, and it raises this sort of existential angst underpinning the bond market, which we'll get into in a minute, which is, our Treasury is still a haven. We'll get to that in a second, but the United Auto Workers ramping up its strike against General Motors, even as trying to get some sort of potential resolution elsewhere. Nearly 4,000 workers at an assembly plant in Tennessee walking off the job on Saturday evening, just hours after Stellantis reached a tentative deal with the union and 3 days after Ford did. GM has reportedly agreed to a 25% wage increase for hourly workers, along with cost of living allowances. To me, this is sort of also the boogeyman in the room, kind of, whether this is the beginning or the end of all the wage pressure and sort of the inflationary moment we're in, Damian.
And this I can't make up or down for. I mean, I'm serious. I thought everything was fine on Friday, right? I thought GM, Stellantis, Ford, everyone agreed to a deal. Everything was going to be fine. And then I walk in this morning and there's another walkout for GM. And it's just GM, right? It's not Stellantis. It's not, I mean, again, I don't know who's running the boat at the UAW, but, you know, it'd be interesting to know where we are today on a Monday morning.
Well, I think it's by design, partly, right? I mean, isn't that sort of the playbook? But can any of this, if they resolve it, give you more excitement around the auto manufacturers? I know you can't really give any kinds of commentary, so just take this. No one's really listening. Just go ahead.
Yeah. No, look, I think that this is a GM-specific issue. We had certainly a UAW-specific issue, but when you look at this in the grand scheme of things, UAW is a very small portion of the overall labor force in auto manufacturing anymore. And now that we do have electric vehicle production as a big component of auto manufacturing, that competitive landscape is probably more important than anything else for GM, Ford, and some of the UAW-dependent retailer, auto manufacturers, excuse me. Okay, so I'm still not awake, and it's nearly 7. Nonetheless, we're still working on this.
You're doing great. Meanwhile, it is a busy week of earnings and eco data. The Bank of Japan rate decision due tomorrow. There is relentless downward pressure on 10-year Japanese bond yields, partly because they've been buying stuff. There's a real question about whether they can continue that. The Fed decision coming on Wednesday, along with the U.S. Treasury's quarterly funding announcement. Thursday, we'll hear from the Bank of England. And we'll get Apple earnings round out the week on Friday with the October U.S. jobs report. My favorite thing is if I go to Damien, he's going to say, but don't forget rate decisions around the world in the developing market. I'll get to that in 1 second.
She has you pegged.
Okay, go ahead.
I will stay with my favorite non-emerging market, Japan, because I think of all the major developed market central banks, the one that has some sort of potential to surprise, it's definitely the BOJ, right? I mean, I don't think they're going to tweak YCC. I mean, I may be wrong there, but what's interesting is we've had a lot of hot CPI prints out of Japan, and they're definitely going to be raising their inflation forecast on a forward basis. I wonder if that alone has the potential to move the 10-year closer to that 1% mark. I don't know.
Yeah, Japan is also the one market in Asia that's really come alive over the course of the last year or so. Japan's been a very big haven and source of trading in the equity markets all of a sudden. And all of us has kind of forgotten about Japan, frankly, until this last year. So what's happening with rates is feeding through to equity markets. Part of it is the tech story as well, but certainly Japan is a big portion of the equity market that we're now paying attention to, and it had been largely dormant for 20 years.
Can I add one thing to that? What's really interesting, and it's at a record level, the amount of retail trading in FX that's coming out of Japan. Japanese household, everyone is trading FX in Japan because yields are so low. Of course you would try to push your money abroad. And I think it's in, like, I don't know what the number is, but it's at an all-time record. It's a fantastic number. So.
Which is maybe the reason why they're struggling to keep it sort of elevated above or below, I should say, 150 per dollar. Joining us now really to dig into this question of what to make of this sort of, I don't know, anomaly of Treasuries not responding the way that you would expect at a time of great uncertainty, the way that bonds are outside of Treasuries and where you're seeing in stocks. Francis Donald, Global Chief Economist at Manulife Investment Management. How much is that sort of giving you agita at night?
A lot, among other things, Lisa. It calls into question some bigger issues that are at play here, which is, as noted, we have a ton of central banks this week. We've got emerging markets, developed markets, Norway, Japan, England, Fed, Brazil, the list goes on and on. And the thing that keeps me up at night, most of all, is not are our economic models broken? We know they need to change. And not even how is government spending changing the game, but is the decision-making function of central banks adjusting in an era where we know inflation is becoming less interest rate sensitive, the bond market is being moved by factors that it traditionally hasn't been, that is to say, more debt issuance. How do central bankers respond to data? And is it the same as what we've seen from the last 10 years? Because we've seen several Fed officials come out and tell us, hey, guess what? Those strong economic data points, they're not consistent with what we're seeing on the ground. And those single sentences that say the Fed is actually taking data with a grain of salt, that's what keeps me up at night, because I can run a model that tells me what the data is going to do, but then I have to develop some sort of model that's going to tell me how people with biases and their own backgrounds are going to interpret it. And that's when the game gets tricky.
So interesting. Can you talk a little bit then about your interpretation of the ECB last week? Is there anything in the ECB or anything that you heard from the ECB that would indicate that central bank decision-making is shifting? Can we look to the ECB for guidance on what to expect from the other central banks this week?
Well, Lagarde plays it close to the chest, but I thought she doth protest too much, methinks. A lot of pushback on, we're not going to talk about cutting rates. And then I thought, I remember in June of 2020 when we weren't even thinking about raising rates. That's what Powell told us at the time. Of course, central banks are going to push back against the idea of rate cut expectations. But look at the projections that come into things like the Fed's summary of economic projections. They already tell us that even with inflation above 2%, they have the expectation to be cutting rates. That is a little bit strange. That's not what we would have thought from the traditional central banks. So we have to evaluate that relationship between interest rates and inflation. And if you're a long-term investor, which most people are, retail investors and institutional investors have a longer time frame the next week or the next decision, we have to start having some very deep conversations about whether the inflation and the interest rate relationship will be stable over time. My sense is it's going to disconnect somewhat, and that matters to a lot of capital market assumptions and where we're going to be 5 years from now.
Francis, bankruptcies are rising, housing activities in decline, credit card delinquencies are above pre-pandemic levels, and yet the risk of a recession has declined. I'm curious what your thoughts are on whether or not the Fed can achieve a soft landing.
My thoughts that the risk of recession have actually increased in this type of environment. Look, if you woke up today and you've been in a coma for the last year, I described all those statistics. I added on that the government had spent basically the entire amount of what they could in good times with GDP at 4.9%. Massive amounts of geopolitical risk we have not seen in ages. And central banks have said, even if we're going to cut less than we have historically. Would you be bullish? That would be really hard to do. So even if you have these priors of having called for a recession too early, which I did, if you look at the economic data today, it is so significantly consistent with a downturn. Now, I will push back a little bit. We do have a recession in our model, but there's this emphasis on recession or no recession. It's so binary. That is not how markets work. If you just look at the balance of risk ahead for growth, we have just seen peak growth in the United States. And markets, more than being recession or no recession animals, are really focused on second derivatives, the change in. The growth impulse going forward is going to be much lower and more challenging. Is that 2 quarters of negative growth or 1 quarter and then flatline? I don't think that matters as much. But yes, if I woke up today and looked at the economic data, I would be really hard-pressed to say, that's a soft landing. Everything's looking great. That's not the case at all.
But haven't we already priced that in? Based on small caps, based on outside of big tech?
Yeah, so it depends who you are. If you're a small cap investor right now, you don't need any convincing that there is weak economic activity ahead. But if you're an asset allocator and you're looking top down, I'm not sure you're as convinced. Now, we have seen moving into correction territory, but you're still in an environment where equities have outperformed bonds, and the traditional asset allocation has not been consistent with recession ahead. So it depends who you are. I certainly have some portfolio managers I work with who are in the banks or small cap space. They don't need to be explained how bad the data is. But if you're sitting at the top level and you're looking down, I'm not sure it's clear how challenging this is. But Lisa, I'll leave you this comment. You know, macro is an imprecise investment tool. It takes into consideration the state of play. It doesn't necessarily take into consideration sentiment, positioning, underlying valuation things. Macro is one part of your toolkit. And yes, as a macro investor, that pains me to say it, but we have to say it out loud. I think that's critical to the story.
So I have to ask a really unfair question. If you could get advanced information from any of the events that we've laid out this week, which would it be?
Oh, I might go a little bit niche with this one and say employment cost index. What is happening to U.S. wages? I think that will be really critical. And I'll give an honorable mention to the Bank of Japan because, again, I'm looking at how is what we've used for the past 10, 15 years changing? And the Bank of Japan really relaxing yield curve control. I'm not sure it'll be as massive and sustained of a market event, but that's another example of how central banks may be shifting their thinking, and we got to adjust some models.
Frances Donnell of Manulife Investment Management, thank you so much. As always, wonderful to see you lay everything out for us as you do with such clarity. Gina, to me, that's one of the big questions with some of the equity returns that we've seen in some of the reports, just how much they can pass along those costs to consumers, because employment costs are definitely still going up.
Yeah, they are still going up, but the bulk of the inflation distress that U.S. corporates had experienced is because input costs were going up, not necessarily because wage costs were going up. Wage costs were accelerating, but input costs were accelerating so incredibly rapidly in 2022. So the downdraft in input costs, or at least the relief in input cost pressure, has provided a lot of relief for U.S. corporates. And the spread between CPI and PPI is still quite positive. So that input cost deceleration is most important. They are still able to pass a degree of increase onto the consumer. And frankly, as long as the consumer has those wages, those input costs are going to continue to be the more important factor.
If Tom were here, he would put up a banner that said CPI, PPI, PCE, and it would be sort of this soup, but basically it's the costs that you've got to pay versus how much cheaper things are that are coming in.
Well, I personally just think Frances is absolutely brilliant, not least of all because she agrees with me on Japan. I think the BOJ meeting is going to be the meeting this week that you have to keep eyes on.
Coming up, thanks, Damien, for that. Now, coming up, we've got Leland Miller of China Beige Book, so you can talk a little bit about China, which I think is actually really important, especially the geopolitical sphere, but also when it comes to the economics of the moment. In markets, a bit of a reprieve, the buy the dip continuing into at least another day.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say, at noon, I want to come in at 1 o'clock, we hold that order and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology. And welcome to Balance of Power.
This is Bloomberg.
The commercial real estate market in China has had a huge policy correction, and I think we are at the bottom of the market, but it will take quite a while for that market to recover and regain momentum. So I'm not expecting a massive reversal in that sector in the next 12 months or so, but I do expect it to be a gradual improvement from where we are.
Noel Quinn, HSBC CEO, talking about the mystery behind the real estate market in China. We aren't really talking about that much. Welcome back. This is Bloomberg Surveillance. Maybe we should be, though. Damien, you were talking about how important it is to really highlight the China picture, both economically and geopolitically.
Well, there's just been a payout on default risk. I mean, CDS and Kogard, there's actually been a payout. Whenever CDS pays out because there's a default, that's never a good thing, right? And now we've got Evergrande, a little bit more can-kicking exercise over the weekend. They got an adjournment. There was supposed to be potentially a wind-up and an actual liquidation, but that didn't seem to be the case. So, we're kind of extending and pretending again in China.
Extending and pretending on the economy standpoint. And Jenny, you've been talking about the geopolitics. Leland Miller has been on the ground, at least with data points, trying to understand what exactly is the state of play. Co-founder and CEO of China Beige Book, one of my favorite people to talk to. And, I want to just start with, is China taking advantage of this moment geopolitically and involved in back-channel negotiations, whether it's with Russia, Iran, whether it's with the U.S., or are they taking this opportunity to shore up their economy in a more meaningful way?
Well, look, they haven't taken advantage of anything geopolitically just yet. But the worry is that as the United States gets more bogged down in one theater, Ukraine, another theater, the Middle East, that this will make a appetizing opening for China to do something on Taiwan. Is that likely? Surely not. But this is the type of evolving situation that we have to see, play out. We don't know how any of these theaters are going to develop over time. We also don't know how much worse the Chinese economy is going to get over time. Certainly, Xi Jinping has his hands full with the problems, back home. So there is a lot of things we don't know here, and this is why it's such a different situation than what we've seen in the last 5 years.
You've been out front, Leland, saying that people were underestimating the economic momentum in China, and not necessarily long term, but at least short term, and people are coming around to that idea. How have you adjusted your view based on some of the recent stimulus that we've seen coming out of the region?
Well, there's no reason to reevaluate it yet because the stimulus hasn't hit. So I think what's important to understand is you see these gigantic stimulus headlines. Everyone's really excited. And they assume, wow, we read a stimulus headline, which means it must be, immediately hitting the economy. What's happening right now is that local governments are issuing a lot of bonds. And we may see a bunch of activity later in the year. But what we're also seeing is corporate borrowing at some of the lowest levels we've ever seen in the history of the survey. Corporates are looking at the economic environment right now, they do not like it. They're not hiring, they're not investing, they're not borrowing. Things are better than last year. It's not a collapse, but it's a really disappointing economic situation. So the idea that stimulus is going to be announced and then put into play and it's going to all hit and things are going to get better, that's never been realistic, and it's not as what's happening right now.
Leland, I was at the Emerging Market Traders Association forum just last week, and the talk was extreme pessimism surrounding China, and the word uninvestable came up over and over and over again. I'm curious to hear your thoughts as a U.S. investor. How should I be approaching China in today's environment?
What we try to stress is not that China is uninvestable per se. It's that you can't invest in China like you did, 10 years ago, even 5 years ago, because the risks are so much more dramatic. The risks are geopolitical, they're trade, they're sanction related, they're related to what's happening in the domestic economy in China. It's just a totally different scenario. And then if you're talking about A shares, of course, the market over there is not a real market, and it's not correlated to the real economy. I think what a lot of large asset managers in particular were used to for many years is they invested in their big tech companies. They love their Alibabas and their Tencents, and they were just used to just collecting dividends on a regular basis and watching the stuff go up. That era is completely over. So China is still, it's not completely uninvestable, but it takes a level of sophistication far beyond what people were used to in the past.
Leland, we see that PMI data out of China this evening. I know you have a much better read of what is actually going on the ground in China. What are your thoughts heading into tonight?
Well, look, October got weaker in our data from September, and September was weaker from August. So, it's funny that we're being called such big bulls right now in Wall Street. We're simply bulls because we don't think China's collapsing, not because it's doing particularly well. It's a sign of the times, I guess. But look, the economy is not doing very well right now. You're seeing stimulus headlines, but you're not seeing anything on the fiscal activity side yet. Our fiscal activity index for October was one of the lowest levels we've seen in many months. So nothing is really happening there. Everything is better than last year, but property's bad. Consumer spending is tapering off. There aren't really that many bright spots in the economy right now.
Can we talk a little bit about expectations? Because we have seen China's correlations, at least in the global equity markets, Chinese correlations relative to the rest of the emerging markets have been extremely low over the course of the last year, given expectations coming into 2023 were so high for China, and then China generally disappointed. Are we at a stage right now where expectations are so low that your probability of improvement in China going forward is actually pretty high?
I think we were there a few months ago, actually. I mean, we were some of the only people all summer long saying China's not collapsing. You're too pessimistic. But keep in mind this, people are and have been too bearish cyclically. But I think they're still too bullish structurally. So yes, we will see an improvement in economic growth in terms of China being better this year than last year. They're probably going to hit their GDP target for this year. That doesn't mean the stock market's going to go up. The stock market is completely uncorrelated to the real economy. So it depends on what you're talking about. If you think things are collapsing, then yes, you're too bearish. If you think things are bottoming out and going to get really good into next year, or even sort of good into next year, you're probably too optimistic. So it's all about relative expectations right now.
Can you talk a little bit about what you see in the Chinese tech sector specifically? I think when you look globally, tech stocks have participated pretty much to a T. Every tech stock globally has participated in the rally in 2023. Certainly, a lot of that optimism has been removed from markets in recent months, but this was a global trade with Korea participating, Taiwan participating, Japan participating, U.S. and even European tech stocks participating, but China was kind of left behind. What's happening in China tech?
Well, look, when the regulatory crackdowns that we first heard about in 2021 were said to be easing, people got excited earlier this year. The tech sector was coming back in China. The caution was always this: corporate governance in China is not improving; it's getting worse. And when you look at the tech companies, you look at the largest companies in China, you have the party getting more and more involved at the board level, in the strategic level. So you could talk all you want about how the tech sector is not being, oppressed in the same way than it was a couple of years ago under one of Xi Jinping's campaigns. But right now, these companies are being led in large part for strategic national purposes, not for innovation. They're not being run for their shareholders. Do you really want to invest in a company that has that mission?
Leland, China's finance minister said the possibility of a Biden-Xi meeting before year-end is far from a done deal. My question to you is, why do we even care? I mean, what is the significance of that meeting, and does it have any potential whatsoever to impact asset valuations in China?
Well, we shouldn't care, except that the relationship has been so bad over the last several years that it's never a bad thing to get leaders in the room talking, open lines of communication, particularly with what's going on around the world. But in terms of there being a breakthrough moment, there being a something related to policy, something changing directory of the U.S.-China relationship, that's not going to happen. And in fact, we're going into a very difficult year next year with the Taiwan presidential elections at the beginning, the U.S. presidential elections at the end. So I think that this is being done simply to make sure that the bottom doesn't fall out in the relationship.
That's the kind of bar that we're at. Leland Miller of China Beige Book, thank you. And I'm just restraining myself, Gina, the sort of, rather catastrophic side of me keeps saying, what's going to happen? All these people, and they have no clue. But the risks just mounting.
Yeah. Well, and I do think it's interesting, this recent campaign between Biden and Yellen and everybody in Washington kind of talking about China all of a sudden. This is no coincidence to me that we're suddenly focusing a little bit on China, given what's happened with Israel, given what's happened with Russia. That is the next area of geopolitical risk that we should be worried about breaking out. And so improving that relationship probably really key to preventing that next level of risk emerging.
But Damien, you asked the right question, which is, okay, everyone's talking about this big summit between Xi Jinping and President Biden. Why do we care?
Right. Why do we care? Well, I'll tell you one thing we should be mindful of, right? I mean, they announced they're going to issue a lot of bonds, right? And they have to fund those bonds, which means they're probably going to have to cut the RRR rate in the not too distant future in order to fund that. I'm talking by mid-November. I think that's what our economists here at BI are calling for, another 25 bip cut in the RRR rate over the next few weeks alone. What does that mean for the yuan and for rate differentials with the U.S.? That's key.
How much are you watching whether they liquidate their treasury portfolio to try to stimulate their economy?
Well, they already are. I don't know if they can liquidate it entirely because they obviously trade a lot with the U.S. and they have a lot of dollar exposure. So I don't think they're killing their entire position, but they have shaved it pretty meaningfully.
And this is part of sort of the backdrop of technical concern for the Treasury market. The reason why people are wondering, will supply dictate everything this week when we get that refinancing agreement, the year funding agreement from the Treasury Department on Wednesday? Coming up, Barry Bannister of Stifel as we parse through a complicated and key week to understand both economics, geopolitics, as well as corporate earnings.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything. Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Your grandfather was a famous basketball player. In fact, he's in the Basketball Hall of Fame. Did you have any of his basketball genes?
You know, in my family, David, you didn't do very well at the family barbecues if you couldn't play hoops.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It is our sense that something fundamental is going on.
We think it is a buying opportunity for the market.
People are making more money. They're feeling very depressed about inflation, but they're still spending.
There's a lot of issues right now that are somewhat inflationary.
Volatility is going to persist until we have a clear inflection in the direction of the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's Monday, and that's about all I can say with certainty. Welcome back. This is Bloomberg Surveillance with Jonathan Farrow, Tom Keene, and Lisa Abramowitz. Tom and John have extended their cruise to the Norwegian fjords. They thought that the thought of Alaska was just so great that they're going to go check them out and room together. Alongside with us, I have bribed them to stay with me for longer, which is a good and beautiful thing and wonderful for all of us. Damian Sassower and Gina Martin Adams on a day ahead of an incredibly busy week. And Gina, honestly, all I can think about is we don't even know how the market's going to respond to data points that we don't really know, and we don't really have a sense of what exactly is going to happen that's going to drive the narrative by the end of today.
Yeah, I mean, I think overwhelmingly the market is so nervous about what's going on in the bond market that all of these central bank occurrences, shall we call them, this week will be certainly paramount in terms of importance. But underneath that surface, you've still got an earnings season coming. You've still got Apple's earnings announcement coming. Apple being one of the biggest stocks in the world, not just the United States, is still very important to consider. Earnings growing at about 2%, much better than anticipated decline. You know, we've got a lot of other things happening that could certainly take hold and drive some degree of optimism, which after what has been a really rough, frankly, 3 months for stocks.
Yeah, you know, Gina, we've been talking a lot today about fundamentals, about technical supply, quarterly refunding announcements, and all that fun stuff. One thing we haven't been talking about is seasonals. And if you notice, we have come out of the seasonally weak, you know, September to October period. Now we're getting into a part of the year where people want to put risk back on. I mean, historically, it's proven to be the right trade. Is now the time to buy the dip? I'm not so sure.
Yeah. BTIG's Jonathan Krinsky came out with this statistic to sort of prove that point. If the SPX closes below 42.88 on Tuesday, it'll be the third consecutive monthly decline. The last time there were 4 consecutive monthly declines in the S&P 500 was 2011. But it hasn't been down 4 straight months ending in November since 1946. You nailed it. So it's exactly that.
Yeah.
And does that apply this year? Because it feels like this year is somewhat different.
Well, every year feels like it's different. Frankly, every year there's a new challenge. I mean, I remember 2018 quite well. Remember 2018, we had this massive tech meltdown. Into October, we had a nice little bounce, and then all of a sudden we had the Christmas surprise. It was central banks that came back again to really bite us, and we saw this huge dip at the end of that correction. So seasonals can help, but only so much in an environment where the outlook is so uncertain, where macro is so uncertain, and central banks are playing such a critical role.
Yeah, no, exactly. And I mean, look, positioning is everything, right, in this market. And, you know, I think positioning is still heavy in a lot of places, a lot of risk asset classes. So, you know, I think investors need to be mindful of that. You don't want to walk into a freight train, as it were, at least.
Yeah, it seems to be kind of a feeling ahead of a week that's going to be kind of tremendous. Let's get right to it. In terms of what we're expecting, the Bank of Japan rate decision is tomorrow. The Fed comes on Wednesday. The Bank of England on Thursday. Damien will remind us of where other central banks?
Malaysia, Colombia, Brazil, Czech.
Norges Bank.
Norges
Thank you.
Bank.
Yes, exactly. And that's going to be important. All eyes on the Bank of Japan.
Yeah, Noki, Stokey. You know, I mean, well, look, I like Noki better than Stokey, but, you know, Noki and Stokey, good friends of mine.
Thank you. I appreciate that. U.S. Employment Cost Index coming out on Tuesday. U.S. job openings on Wednesday. U.S. initial jobless claims and productivity Thursday. You're cracking me up, Damien. And U.S. employment report on Friday. Gina, how much are people going to really understand what to do with employment cost index that's going up. To Francis Donald's point, is that going to be kind of one of the key points?
You know, I think that this narrative of wages accelerating has been in the market for quite some time. You'd have to have a big shock on that number to make it really move the market. In my opinion, considering everything else that's going on, perhaps that's the key indicator, as Francis suggested, for the broader economy. But is it really that important to the equity market? I think the equity market is going to be paying much greater attention to just jobs in general. Some sign of continued stability, some sign that we're not falling into a recession. While the employment costs are important, they're not the overwhelming concern for the equity market at this point.
And maybe they'll all just be watching the balance sheet of Apple. Wednesday, we get the Treasury refunding announcement. That's the balance sheet of the U.S. And then on Thursday, we get the balance sheet of the rest of the U.S., which is Apple, when they report earnings. And I guess that, you know, I want to go to you, Damien, with respect to the refunding announcement. What the sort of how low the bar is for a pretty significant surprise if the U.S. announces that it's going to really increase the size of each of their coupon offerings, the 10-year, the 30-year, the 5-year, at a time where we're not sure where the bid's going to come from.
Well, for me, I mean, it comes back to what we're seeing in the Middle East, right? I mean, we've just got a $106 billion proposal from the president to kind of fund the wars in Ukraine and Israel, et cetera. And for me, it's can this economy afford that, given the CHIPS bill and the Inflation Reduction Act? And, you know, Wednesday's a very, very important day. And again, it's not because of the Fed. And I believe that the pause is all but priced in. That QRA is going to be something special, I believe.
And what will it do with yields? I mean, honestly, I think that one of the things the equity market might start to take solace in is the idea that the dollar stopped rising, that yields at least may have peaked in the middle of this month. If those peaks prove to be sort of the longer term peaks, that could add a lot of support to the equity market that we haven't had for 3 months long. So I do think what happens with long end yields is pretty important this week.
That's going to be something that I posed to Barry Bannister, a great place to start. Chief Equity Strategist at Stifel. Is it all about yields this week?
Well, I do think that the yields and the re-rating of yields has led to the de-rating of equities, and that's been a big issue for the market to deal with. If you look at the price of oil, where it is on a 3-month futures, it lines up very closely with what we call break-even inflation, 10-year minus the tips real yield. So that's about 2.5, and if you look at what the Fed's done on the rate futures, they've driven the 10-year tips yield up to about 2.5. So 2.5 plus 2.5 is why we have a 5% handle or close to it on the 10-year yield.
Basically, one of the questions is everything pretty much priced into stocks, right? I mean, if we sort of are volatile within a band that goes from 5% to 4.85%, and this sounds super technical, but basically we don't break too far out of that 5% level on a 10-year yield. Can you get enthusiastic about buying stocks, particularly those that have been most beaten up, like small caps?
Small caps, international, and value relative to growth are all what we call one big trade. They tend to do well in a more reflationary and stronger economic growth environment. What we have been emphasizing is what's called cyclical value. These are things like capital goods, financials, transportation, basic materials, energy. And on the short side or the opposite side, you know, your media, your entertainment, your internet, semiconductors, your tech hardware like Apple, autos, Tesla, 85% of autos is Tesla. These would be the shorts. So, yeah, I agree with your earlier when you were talking about the seasonality. November 1st to April 30th, the cyclical value tends to beat the cyclical growth, and we're on that trade. But for the overall index level, no, not much more than 4,400.
When you talk about that trade cyclical value, Barry, what do you think is the catalyst to get that moving? Beyond seasonality, what are you looking for? Is it an earnings catalyst, a yields catalyst? What is going to drive capital into those riskier trades?
You know, when you look at all the economic data that's available to us, and then you settle on the ones that statistically are the most useful, that we find that ISM PMI manufacturing index is just incredibly useful. Our target there by April of 2024 is 53. Over 50 is growing, and it's bottomed at recently at 46, and it's headed towards 50. If that happens, then that's associated at 53 ISM PMI manufacturing with stabilizing wages. You know, the Atlanta Fed wage tracker, the ECI wages and salaries, that'll stabilize. We'll need productivity to avoid a high core inflation rate if that occurs. Also higher commodities. They swing from being down 25% on the Bloomberg Commodity Index this year to being up 10 next year. So that's all positive, and that's what drives the cyclical value trade relative to the classic cyclical growth trade, which is big tech.
Barry, dollar strength has been a feature of the 3-month, or call it 3.5-month sell-off in risky assets. And I'm curious, what is the impact of a stronger dollar on U.S. equity earnings, and what are your thoughts on the dollar going forward?
The dollar is one factor in earnings. The other is, what happens, as Gina's often talked about, what happens to margins. Margins were prolonged, I think, by some of the cost cutting in tech. They had 12 years to build up a layer of fat, and all they did was lose that. And so they were able to preserve their margins. The dollar is stronger, has been stronger because of the rate differential. Real and nominal rates in the U.S., the Fed is just well ahead of other central banks. Now that the Fed is probably closer to having finished the rate cycle, we can focus on global economic growth. And the global LEI year-to-year change has begun to pick up. That's, again, why we prefer the cyclical value over the cyclical growth trade for 6 months.
Barry Bannister of Stifel, thank you so much for being with us on a day ahead of a really important week. And Gina, that to me is sort of the conundrum, and it's sort of a theme this morning, which is you can get right the concept, but convincing other people to come along with you is a totally different story. Basically, I feel like the template for this morning is me saying, is this normal? And you saying, yes, this happens every year. Is this normal, though?
Well, look, I think that the other thing to consider is every year is different. I do think that it's been an abnormal experience over this cycle because of the inflation dynamic. And we've talked about this a little bit. And Barry mentioned that I talk about margins all the time. I'm becoming known as the margin person because inflation has been so consequential to driving overall trends in equities. And it still is very consequential. And this is a big adjustment process for us because we didn't have to contend with a consequential inflation for most of our career. So I do think that it is different. It is certainly this environment of wars breaking out all over the world is also very different this year relative to past years. So there are certain differences, and the movement in yields has been so painful.
Well, Gina, let me build on that.
Over the course of the last 2 years.
Let me build on your comment about margins and take that to the financial sector and talk about net interest margins. Right now, we've got a steeper curve, right? I mean, banks can maybe begin to think about making money again in this environment. I mean, go figure, right? So I wonder how that changes sort of the dynamic and how people are going to look at financials and the big banks in lieu of what we're seeing. I mean, I don't think earnings are going to be so great, but I'm curious to see how they kind of wind up here.
This is going to be one of the questions, especially as we've seen regional banks really struggle. When people talk about some of the potential pain points, you can see that. And when you talk about the yield space, just let's take a look at what we have seen in yields. They are climbing a little bit today, but honestly, I really can't stress enough. Anything can happen as the day goes on because the volatility has been tremendous. Right now, we're looking at yields that something are 4.86%, around that, 4.89% climbing as we speak. Really, again, the volatility here has been tremendous. S&P futures 4,163, up 0.6%. Right now, I do want to go to that question, though, Gina. I mean, from the perspective of banks, when do they catch a bid? When have they fallen enough?
Probably when we start to see loan growth accelerate. So you talk about NIM, right? You talk about net interest margin. The potential is there, but the problem is nobody wants loans. So the financials can't make money if they don't have any top line growth, even if NIM is widening. And with the whole curve much higher, the entire yield curve is much, much higher than it was 1-2 years ago. There's just not a lot of demand for loans, and that is keeping the financial sector constrained in an environment where they're also somewhat risk intolerant, and the non-financial, non-public financial companies can be a little bit more risk tolerant. So that creates a lot of competitive dynamics that I think are going to keep the financial sector, unfortunately, somewhat suppressed in the near term.
Honestly, I keep thinking about what this means for liquidity. I mean, Damien, every time we talk about strange moves.
Well, you know, you mentioned the real yield, the 10-year real yield at 2.42%, right? I mean, think about what we've just witnessed over the last few weeks. This was not a move that was driven by real yields expanding that, like we've seen in the last few months. This was about break-evens. This is about the market coming to terms with the fact that the Fed is going to pause on Wednesday, right? And so I believe, you know, this is an interesting dynamic as we move from this whole real yield expansion, which is awful for risk assets, into inflation break-evens and inflation expectations. That's kind of a dynamic.
And and the University of Michigan sentiment survey that came out on Friday no one seemed to care about it that much, which was sort of surprising to me because it highlighted how much inflation expectations, at least in the near term, are spiking.
Yeah.
It kind of goes to this question. If we start to see a real acceleration, what that does. We're going to talk about that with Barbara Reinhardt of Voya Investment Management. She's coming up at 8 a.m. She has been correct on stocks and bullish. Let's see if she's changed her mood at this time.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
We are going to move a standalone Israel funding bill this week in the House. I know our colleagues, our Republican colleagues in the Senate have a similar measure. We believe that that is a pressing and urgent need. There are lots of things going on around the world that we have to address, and we will. But right now, what's happening in Israel takes the immediate attention, and I think we've got to separate that and get it through.
Hearing from the very new House Speaker Mike Johnson speaking over the weekend on Fox, talking about a standalone bill rather than uniting the Israel-Ukraine conflicts together the way that President Biden has proposed. This has been a perennial question. How is this House going to pass anything at a time of such incredible division? The division is both in the U.S., it's also around the world, including in Israel. And joining us for team coverage right now, Bloomberg's Oliver Crook in Tel Aviv and Anne-Marie Herdern in Washington, D.C. Ali, I want to start there. Netanyahu, Benjamin Netanyahu, the Prime Minister of Israel, an incredibly polarizing figure before the war broke out, came under a lot of criticism for some of the intelligence failures, did not accept responsibility, put the blame on some of his intelligence officials. How much is he losing the room? Is he losing the ability to lead at a really fraught time?
I mean, listen, the huge amount of pressure is building on the Prime Minister, Benjamin Netanyahu. And again, as you mentioned, the context in which this is all happening since this war broke out 3 weeks ago, before that, it was all about the rift within the society, which has not been healed, right? It was put to one side because of the war effort. Many of the people, the hundreds of thousands who went to the streets to protest against Netanyahu, rallied behind the war effort. And so for him to go out publicly on social media to basically divert the blame of the attacks and saying that basically it was a failure on his intelligence and the defense side of it rather than his own responsibility was taken extremely poorly, particularly when it was given after a joint press conference by the War Cabinet, which is composed in part from an opposition leader, right? That is supposed to be a symbol for this sort of unity. For him to go out and do that, he then deleted it. He then apologized. But again, it speaks to the heart of this issue within Israeli society and the mounting pressure on Benjamin Netanyahu. And then again, probably too early for this conversation, but the longer term, what will be the government that comes after the War Cabinet? Because this will be fundamental in shaping the future of Israel, but also its relationship with Palestinians.
And the division is not just isolated to Israel. Anne-Marie, over the weekend, a series of articles about how President Biden is losing some of his constituents, including in certain swing states like Michigan. Axios coming out talking about how some of the officials advising Biden think that it has never been worse politically for him. How does this sort of play out longer term and shorter term in your view?
Well, domestically, the president is still dealing with weak poll numbers when it comes to the economy. Things like inflation continue to top as a part of America's biggest concerns. And now he has another foreign policy crisis, this time in the Middle East. And one of the biggest concerns for this White House is to contain it. It's one of the reasons why it's going to be so interesting when Khalid bin Salman, the Saudi defense minister, comes to Washington, D.C. today. It is clear this administration wants to contain what is going on in the Middle East. But what you're seeing in a state like Michigan, which is a key swing state. And remember, Hillary Clinton lost Michigan by just over 10,000 votes. If the third-party candidate wasn't there, she probably would have won Michigan. This is critical for the Democratic Party. Biden has two issues in Michigan. One is the fact that there is a large population of the Palestinian diaspora, Muslim Americans. There's been a lot of reporting. NBC had a brilliant story out talking to people who said that we're just going to stay home. We're not going to go out and vote for Joe Biden. We feel like he let us down. There's also the UAW workers and those households. And our poll, when it looked at these swing states, showed that the former President Donald Trump is actually making headway into some of these UAW households, which is why Michigan is really an interesting state.
Talk to us a little bit, Anne-Marie, about flash forward 1 year. I know it feels like a long time from now, but we are just a year out from the 2024 election. How critical is this issue specifically in the election landscape relative to everything else that's going on?
I think there's too many questions still that remain to try to understand how important this will be on Americans' minds when they go out and vote in just over a year's time. But of course, the fact is, if this does become a wider regional conflict, this can have a tremendous impact on the election. Not just right now, we're talking about the Palestinian diaspora within the United States that potentially voted for Biden in the last election, but maybe will stay home in this one. But what does this mean if oil prices are higher? What does this mean if more Americans are killed in the line of combat? We did see that there's been an increase, an uptick of missiles that are hitting U.S. bases in Syria and Iraq. What if that continues, and what if this metastasizes? And if that is the case, then this could be incredibly difficult for this current White House and then the Joe Biden campaign to really go out and make their case to continue the presidency next November.
Anne-Marie, it's a loaded question. I know, but I'm going to ask it of you anyway. Where do you think the majority of Republicans and Democrats sit with Israel and Palestine? Do they support a ground war in Gaza? Do they support a two-state solution? I'm just curious to hear your thoughts. The average Republican, the average Democrat, what are their thoughts on Israel? What are their thoughts on Palestine?
There's a lot of bipartisan support to make sure that Israel has the funds they need to defend themselves. And that's what we heard from the new speaker, Mike Johnson, over the weekend. He says this week he wants to pass that aid to Israel, and he says he can have bipartisan support in the House. The issue, of course, that he has is he's coming up against more traditional Republicans who want to see the big package. You saw what Mitch McConnell said just the previous weekend, that there are bigger power struggles when you look at China and Russia, and the U.S. needs to be funding all of these national security concerns around the world. So bipartisan-wise, there is a lot of support on the Republican and Democratic side with Israel. You've seen a number of senators and congressmen and women actually fly to Israel since the October 7th massacre to make sure they are standing shoulder to shoulder. At the same time, you will hear politicians talk about the fact what President Biden has been talking about. They want to make sure that if Israel, and they already are going in on this ground invasion, that they are doing so by making sure they're protecting civilians and also pushing for more humanitarian aid to get into Gaza, which this weekend was incredibly difficult.
From your perspective, Ali, on the ground in Israel, how much unity is there still as the war grinds on? I mean, we talk about keeping the room in the U.S., but how about in Israel?
I think that overall, fundamentally, a lot of the Israelis see this as a sort of existential threat and not just sort of a rhetorically so. So I think there's, to a large degree, still support. There is some discussion and there is some disagreement about the amount of emphasis that's being put on the hostages. Of course, there are many people here who have family and people that they know that are still being held by Hamas. There is some concern around the idea that the military objectives might take precedence. And again, we have more than, the number keeps shifting, but 239 some odd hostages that are being held in Gaza by Hamas. So this is a sort of one of the main issues. But in terms of, again, it'll be interesting to see how it develops with Benjamin Netanyahu, and if he continues to distance people with the kind of pronouncements that he made over the weekend. Again, what is the alternative? The idea is that this war government will be in place until they reach their objectives. The question is how long is that going to be?
Oliver Crook and Marie Hordern, both of you, thank you so much for giving clarity to a highly opaque time. And I am continually struck, Damien, by just how sort of not clear some of the social media has been. And people who get their views from social media have gotten very distorted views, and it sort of seems like a different front for wartime information.
Myself included, by way of example, there was a protest in Grand Central Terminal just this weekend, right? I think, and if you look at the shirts, it says, Jews in support of a ceasefire. So that's why I'm asking these questions. Do Jews on average in the U.S. want a ceasefire? Do they want war? I mean, what do people really want and stand for? The ambiguity is just so thick, it's hard for me to cut through it.
Yeah, and let's not forget that social media is specifically targeted to you based upon what you have historically consumed. So you're not necessarily getting the full unbiased picture. You're getting a very targeted view. And how true is this view, right? It's largely opinion-based in a lot of ways. It's targeted to you. So how much credence can you give it?
And
but yet, this is where people get their news.
I think it's a great point, too. It's targeted for people, which might be one reason why you're seeing the polls on either side get more extreme and less willing, maybe, to talk. Unfortunately, that seems to be somewhat the case. Coming up next, Andrew Sheets of Morgan Stanley is going to be joining us as we try to parse through some of the geopolitics and understand how much the nuts and bolts still matter.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Bit of a bounce to start a big week up ahead. Welcome back to Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz, Tom and John still on the cruise. They will come back later this week. We are looking at a bit of a bounce. S&P futures up about 0.6%. What I find fascinating, though, is that the S&P has been down 10% since the end of July. The NASDAQ has been down 12%, and the Russell 2000 has been down more than 17%. Alongside me, I'm so glad to say, Damian Sassower, Gina Martin-Adams, as we parse through a tumultuous time, and that sort of question of whether we can buy the dip really feeds into what's the compass of the moment.
Yeah, and frankly, when small caps are breaking down to new lows, it is a very big sign of just how much risk tolerance in general is breaking down, which is intriguing because risk tolerance is breaking down at a time when earnings are actually showing a degree of resilience, and much better than expected results have certainly emerged out of the course of the third quarter earnings season. Nonetheless, the markets are telling you that nobody has any tolerance for risk, and it's really difficult to see where the catalyst for resumed risk tolerance comes from.
Again, you talk equities, I'll talk credit. 4-to-1, that's the ratio of downgrades to upgrades in credit this year, in U.S. credit. I mean, so it just speaks volumes in terms of what the fundamental outlook is on a forward basis. And I think going forward to next year, if you look at emerging markets, 7 of the major 14 sectors that I cover in EM credit are expected to have a negative outlook next year. So things are not getting better, they're getting worse.
We're going to get to that conversation with a fantastic guest, Andrew Sheets of Morgan Stanley, in just a minute. Under surveillance this morning, Israel expanding ground operations in Gaza over the weekend. The Israel Defense Forces saying over 600 militant targets in Gaza have been targeted, including a few retaliatory strikes in Syria. Internally, Israel's Prime Minister Benjamin Netanyahu is under increasing pressure to resign after a now-deleted social media post blamed the country's security officials for the October 7th attacks. Netanyahu has since apologized. It hasn't really quelled some of the ire in the population that already had soured on him. One thing you said, Gina, in the break that I thought was so profound is that you spend a significant part of your time trying to strip out the noise.